Okay, so I welcome you to revision day one for public sector accounting and finance, which we are going to be looking at the question number one in the exam hall, the topics that you are going to be having under the question number one. We will be looking at those topics. We will try to uh, summarize everything about those two topics, and we will pick some tutorial questions on them to see if we can actually remember certain things on them. Okay, so we'll be doing we'll be doing all the 5 questions. We'll be doing all the 5 questions, and uh, the final one will be the calculations, which will be the question number 2, final account for public sector accountants. Final account for public sector entities. It can be covered entities. It can be the central government itself. It can be about anything. It can be a cash flow. It can be statement of financial position. It can be anything, which will be for 20 marks. Okay. And we also look at the ratio analysis. That will be for question number 3. So today we look at the question number 1. That will be conceptual framework and accounting policies and concepts. Tomorrow we try to look at maybe public procurement and public-private partnership. That will also be another 20 marks area. And day 3, we try to look at maybe question number 5, which will be on any area, especially the environment for public sector accounting, which can be the functions of those charged with responsibilities when you come to management of public funds, the controller and accountant general, what are their functions? If you come to the Minister of Finance, what are their functions? If you come to the Parliament, what are their functions? We look at them, and we also look at the issues of budgeting, and we look at some areas. Those areas, they can throw any question over there. Then we now focus on the PEFA analysis and the analysis of financial statement, then the final account. The final account, we do that on Saturday because of how it is going to be. So Saturday will be like 4 hours or maybe 6 hours. So we use that one for the final account. But this morning, which is done, we are going to be looking at issues of accounting policies and the conceptual framework. Accounting policies and conceptual framework will always be the question number 1. Okay. The accounting policies and concepts will be for 10 marks, and the conceptual framework will also be for 10 marks. Okay, but the issue is if you talk about the accounting policies and accounting policies and concepts, okay, we are talking about the assumptions behind the recognition of certain items in the books of the public sector entities or in the books of any organization that prepares what financial statements. Okay, what are the bases? What are assumptions behind the preparation or the recognition of certain items? If you are purchasing motor vehicle on credit and you are recognizing this in your books, you are not paying cash. Why are you recognizing this? You haven't paid cash for the item. You are recognizing this in your books. Why? You might be recognizing that based on a certain assumption. You can purchase a motor vehicle on credit and you will never recognize any transaction or any record on this particular item. You are not going to be recording this in your books. Why? You are saying that, okay, you haven't paid cash for that particular item. This is also based on a certain assumption. Okay, so those assumptions that are behind the preparation of the financial statement, those are what we call the accounting policies or the concepts. All right. And if you come to the accounting policies and the concepts, those assumptions that we use with regards to recognition of items in the financial statement, we have basically two, which we call the basis of accounting policies. We have only basis, the assumptions that we use, how the transaction should be recognized. We have basically two, but most of the times, because of the limitation of some of them, we try to modify them. Okay, we try to modify them because of the limitations that these two are presenting. So we try to modify them. So we are going to be looking at those bases with their advantages and disadvantages. And we also be looking at the other ones if you count to public sector accounting. So if you count to those as options that we use, how the financial statement is being prepared, the basis that we use in preparing the financial statement, the selections of the as options based on which we prepare the financial statement, we have basically two, but because of the challenges that they present in real life, we try to modify them. So we have four bases. Okay, so we'll be looking at the basis of accounting. Okay, so we have the cash, we have the accrual basis, which is now the most popular. We have the modified cash basis. Then we have the modified accrual basis. All right. Please, if they say cash basis of accounting, okay, what is the meaning? Cash basis of accounting.
Senior.
Yes, please.
The cash basis is where transactions or events are recorded when money is paid or when money is received. And it does not recognize, under cash basis, they don't recognize assets and liabilities.
Okay. All right. Nice. Okay. Okay. So we have the cash basis. Okay. The cash basis, what we do is you only recognize an item in your books when cash or cash equivalent has been received or has been paid for that particular item. Okay. So it means that if you are carrying out a transaction on credit, there is no going to be an entry for that particular item. And under the cash basis too, there's nothing like liability. What do you mean by liability? We only have a liability when a transaction happened on what? On credit. Okay. You purchase an item from somebody on credit. That person, you are having an obligation towards that particular person. Okay. And since you are recognizing items, the method that you are using is that, okay, I'll only recognize transactions when cash and cash equivalent has been what? Paid for that particular item. So there's nothing like liability. The only asset that we have under the cash basis is cash. Okay, those capital items, they are treated as if they are also revenue items. So if you purchase equipment, you are going to be writing off the equipment as an expense, which is not going to be presenting what a true picture of whatever is happening for that particular period. So for the cash basis, we only recognize transactions. It's a method that determines when transactions should be recognized, or transactions should only be recognized when you are paying cash or cash equivalent, or when you are receiving cash and cash equivalent for that particular item. So there's no issue like liabilities, and there's no issue like asset. The only asset that we have is cash and cash equivalents. All right, let's come to the accrual basis. Let's come to accrual basis. The cash basis, it means that if you are an organization, if you are a public sector organization, or if you are an organization on its own, and your transactions are on credit basis, it means that you're not going to have anything in your books. You recognize transactions only if cash or cash equivalent is being paid or received. Then what if you do your transactions on credit basis? You are going to be selling a lot of items. You are going to be having a lot of items over there, but there will not be any entry to these transactions because no cash is being paid, which is crazy. So if a company is trading on credit basis, it means that using the cash basis, no transaction is going to be recognized in their books. And they are going to be saying that nothing has happened during the year. No. All right. So for this particular reason, a situation where company will be operating on credit basis, and they are not going to be having any transactions in their books when they are adopting cash basis, we have to do something about it. The company will have zero stock, but there's no entry to show for their stocks. Okay, so this is not going to be giving us a true picture of what is happening. We have sold items, but still there's no recourse to that because we didn't receive cash. And this is going to be, if we are saying these things to the owners, if you are saying these things to people who are interested, the users of the financial information, they are going to be very disappointed. You don't have any recourse on stocks, yet there is no goods in your what? In your store. How? So we need to find a basis, or we need to find a method that will tell us when we should recognize a transaction. And that is what we are coming to look at as the accrual basis. So the accrual basis is coming in as a result of what? Certain limitations of the cash basis. So let's come to the accrual basis. Let's have the accrual basis. If they say accrual basis of accounting, what do we mean? Accrual basis of accounting.
Okay, I think with accrual basis, it has to do with both whatever happened during the year. You have to record it, whether cash was received or not. You have to record it.
All right. Okay. All right. So for the accrual basis, that is what the public sector is now. They are now doing everything possible to adopt the accrual basis in full. And accrual basis give us a real picture of whatever is happening during the year. So as soon as a transaction happens, whether you have received cash or not, as soon as the transaction is going to be captured in that particular year, or the transaction happened in that particular year, it should be captured as one of those transactions that happened during the year. If you purchase an item from a supplier without paying cash, this transaction happened during the year. You have an asset and you are having an obligation towards that particular supplier. So you are going to be having a record on that. Okay, so this is a situation where we record transaction, whether cash has been received or cash has not received. As soon as the transaction happened within the year under consideration, we need to pass entries for that. Okay, the accrual basis is based on what? Is accrual basis presents information on going concern basis. But if you come to the accrual cash basis, we are writing off an asset as if these assets are not going to be existing, as if the company will not be in existence again, as if the entity will not be in existence again. So we are writing off everything that is coming in form of cash. PPEs are being written off. It means that we are not taking these PPEs to the next year. So it is based on their cash basis does not record transaction on going concern basis. We assume that the entity is going to end operations for that particular period. That's why we are writing the asset that will last for 10 years in a particular year. All right, so for the accrual basis, whether you receive cash or not, you have to pass entries. Okay, so the accrual basis combine, we can get information from cash basis for accrual basis because it will still look at cash transactions and also credit transactions. And accrual basis is now the popular one that is, and the financial statement will always be based on accrual basis, where you'll be capturing both cash items and also credit items as far as they are going to be happening within that particular year. Okay, because of the limitation, the cash transactions, we only record transactions that are on cash basis. And we don't have any issue of asset and liabilities. Okay, so something will happen. You sold goods to somebody for 20,000 on credit. This has not been captured as what? As revenue. Okay, at the start of the year, which is January, the person has paid the 20,000 to you. Okay, this 20,000, you cannot record this 20,000 as receipt for or as revenue for the what? The subsequent year. It is for this year. So how do we make sure that, or how do we try to ensure that this 20,000 that we have received for sales for the previous year be captured in the previous year's financial statements? We try to give an allowance to items that are on credit basis in the previous year. In the current year, mostly 3 months allowance is given to them, so that transactions that are on credit basis in the previous year, when they are captured or when they are being settled or when they are being received in this current year, we can go back and enter these particular transactions. So the books will be open for like 3 months. So the year has ended. 2020 year has ended, January to December. So we now open the books for like 3 months to March. So this March, what are we doing? Those transactions, those credit transactions that were not captured, if any of them are being settled within this particular period, this particular grace period, they will be captured in the what? In the previous year's financial statements. So this is something that is being done to capture some of the limitations of the cash basis of accounting. So the books will always be open for like 3 months to record transactions that are relating to to the previous year, the credit transactions. So if you purchase an item from the person on credit and this particular amount has been settled in the first 3 months of the current year, this will now go back to the previous year's books. So we give an allowance for the previous year so that we can capture some of the credit transactions that will be settled in the current year. So we give an allowance, we modify it. So we try to capture some of the credit items. Not all of them will be captured. Those that are going to be settled within the grace period will be captured. But those that are not settled will not be captured. It means that still the modified cash basis will not be solving all the problems, because you can have a transaction on credit basis which will be settled in 2 years' time. Still, it will not be captured under the cash basis. Even if you modify it, it will not be captured under that particular basis. So still the cash, the modified or the cash basis will still be presenting problem because transaction can happen on credit basis that will be settled in maybe 2 years time or 3 years time, and we are giving allowance for only 3 months. Still, it will not give us a true picture of what is happening for a particular year. Okay, so we try to bring in some of the credit items into the cash basis by modifying it, by opening the books for like 3 months for every year. So mostly it is January to March. The books will be open to capture maybe some of the items that are on credit basis and they have actually been be settled for in the subsequent or in the current year. Okay. The accrual basis also, we are saying that accrual basis, we are saying that when cash or cash equivalent has been received or not, as soon as a transaction happens or as soon as a transaction occurs, we have to recognize that particular transaction in our books. But what happened is that it's not all transactions that we can be able to determine if we are going to be receiving money or we are not going to be receiving money for it. Some transactions, when they happen, it is likely that you are not going to be receiving that particular amount of money. So if we find it difficult to apply the accrual basis, we now bring in what? Cash basis. So the modifier is a situation where those items that cannot be measured using accrual basis, we now use cash basis to what? To measure those items. So the modified accrual basis now combines both the cash basis and also the accrual basis. Accrual basis is applied for transactions that we can actually determine based on what? Accrual basis. So we have the provisions now. Those items that cannot be determined using accrual basis, we now apply the cash basis for them. So the modifier is a situation where if the accrual basis cannot be applied, we now bring in the what? The cash basis. And mostly the modified one, we apply the cash basis for revenue. Mostly. Okay, mostly. But if the revenue can be determined, we have situations with bad debts. When you sell on credit, the people might not be paying all the money that they are owing you. Okay, so we can say that, okay, let's recognize the revenue based on the amount that we have received. It is not certain that we are going to be receiving those money from those people. Anything is possible. Issues of bad debt. Okay, so mostly we use if you count to the modified accrual basis, we recognize revenue using the cash basis. Mostly. It doesn't mean that you have to recognize only revenue based on the cash that you receive. No. If you are certain that you are going to be receiving the money from your customers, you still use the accrual basis. But situation where you cannot determine the possibility or the probability of receiving those funds from those people, then you now apply the cash basis to the revenue because of the issues of bad debts. But if you are certain, then we only make provision for those bad debts and still recognize our revenue on accrual basis. So the modified basis combines both the accrual basis and then the cash basis. A situation where we cannot apply the accrual basis, we now bring in the cash basis. And a situation where we cannot use the cash basis, we now bring in the accrual basis. That is the modified accrual basis. It combines both the cash basis and the accrual basis. Where the accrual basis cannot be applied, we now bring in the cash basis. That is a modified one. All of these methods have characteristics and they also have advantages. All right. They also have advantages, they have characteristics, and they have disadvantages. And the question can be thrown to you that you should state the advantages or maybe the characteristics of any of these methods. And they can also give you items. They can also give you items that, okay, how these particular items will be recognized under cash basis, how these particular items will be recognized under accrual basis, or they can ask you for the difference by giving you certain items that you should recognize certain items. They can give you assets that under the cash basis, you should differentiate between cash basis and the accrual basis when you come to this particular transaction. So they can give you assets. If you count to assets, we only recognize assets when cash or cash equivalent has been paid for them under cash basis. And this, if it is a capital items, it will be written off in that particular year. There is no room for what? Provisions. We don't charge consumption of what? Fixed capital under the cash basis. It will be written off. So if you count to assets, how do you recognize assets? Assets will be recognized when cash or cash equivalent has been paid for them. And these assets, if they are of capital nature, it will be written off, no allowance for what? For capital consumption of those particular assets. But if we count to the accrual basis, asset will be recognized even if we paid cash or cash has not been paid. As soon as the transaction has happened, we recognize the what? The asset. These assets are going to be capitalized and will be what? Consumed over their useful life. So there's an allowance for those particular assets when you come to accrual basis. They can also give you about liabilities. For cash basis, there's nothing like liabilities. We don't recognize liabilities because we only have liabilities when transactions are on credit. But since we are not recognizing credit transactions, there's not going to be any entry for liabilities. But if you come to accrual basis, liabilities will be recognized. Even provisions will also be recognized in terms of liability. A provision that you are going to be making, you have the possibility of dismantling some item, okay? Or you have a court case that you are going to be settling. You are going to be making provision for that. You have a future obligation that you are going to be what? You are going to be settling. So if you come to accrual basis, that is where we use the recognition criteria. Okay, as soon as you have a present obligation to settle a particular amount in the future, you have to make provision for that, or you have to recognize that particular item. They can also give you expenditure. They can also give you revenue. That you should differentiate between these two when it comes towards the recognition of certain items. So they can give you the items and they will ask you to use the item to differentiate between the cash basis of accounting and then the accrual basis of accounting. These are general basis. These are general methods that we use to determine when a transaction should be recognized or when a transaction should not be recognized. So this is for both the public sector entities and also the private sector entities. But if you count to the public sector itself, we have other techniques that we use to record transactions. We have other techniques or other methods that we use to record transactions in the public sector. And you really have to read about those ones. So we have the techniques. We have the techniques that we use. Okay. So can you go over the major differences and okay. Let me see. Okay. So accrual basis and modify. Okay. The accrual basis, what we do is that we record transactions, or transactions are recognized as soon as they occurred or as soon as they are being earned in terms of revenue. Okay, so revenue, as soon as the revenue is being earned, whether you have received cash or cash equivalent for that, you have to what? You have to recognize or record that particular item. So if you count to expenditure, as soon as the expenditure has been incurred, whether you have paid cash or not, you have to recognize that. Okay, but if you count to the application of the accrual basis will not be applicable to all the items. Okay, so if we count to revenue right now, okay, we have sold on credit to certain people, we have received some portion of the amount. Okay, what is the assurance that the amount that the people are owing us, we are going to be receiving it? Okay, there's also a possibility that the people might not be paying. Okay, if the people might not be paying, it means that they are not going to be paying. So there will be a bad debt. There will be an issue of bad debt. Okay, so since we cannot determine whether those amounts are going to be settled or whether we are going to be receiving those amounts, let's not limit our revenue to the cash that we have received. So the modified accrual basis comes in, or the modified accrual basis combines both the cash basis and also the accrual basis. The cash basis will only comes in when accrual basis cannot be applied for a particular item. So situation where we cannot apply accrual basis fully to a particular item, then you bring in the what? The cash basis. And mostly the cash basis is for revenue. So you will still be applying the accrual basis under the modified. The situation where you cannot apply the accrual basis, you now bring the cash basis of recognition into that particular regard. So the modified is just you combining both the cash basis and then the accrual basis. But the cash basis will only come in when the accrual basis cannot be applied to that particular situation. So mostly we use the cash basis for revenue because of the possibility of the bad debt and all those things. So you will not be, if you can apply accrual basis to the transaction, apply the accrual basis. Cash basis will only come in when the accrual basis seems to be what? Inefficient or inapplicable to that particular transaction. That's why we have the, so the modifier combines both, but the cash basis will only come in as a situation where the accrual basis is not applicable. And that is mostly we use the cash basis for revenue recognition and the accrual basis for expenditure and other items. Senior juniors, I hope you are okay now. Okay. All right. So they can ask you about advantages and the disadvantages. The cash basis, you can see that the cash basis is very simple to understand by a mere taxpayer because they are telling that, okay, this thing they have paid 10,000 for it. That is why it is in the books. Yes, I also understand. And it's very simple to, it is very simple to apply. And it is not time wasting. You don't have to go and be charging for liability provisions, depreciation, and those things. Okay. But the issue is that it does not give a true picture of what the performance of the transaction or the performance of the entity as a whole. It does not give a true picture of the performance of the entity, and it also does not make allowance for provisions. It does not recognize liabilities. It does not recognize what? Assets. And if you are not recognizing an asset, how do we manage our assets? You purchase an asset for 10 years and you are writing it off. How do we know when we should replace those assets? How do we know the whereabouts of those assets? There is no records on assets. How do we go about that? The only thing is the cash. But if you count to the accrual basis, it is giving us a true picture of whatever is happening. It gives us a difference between the capital expenditure, also revenue expenditure, and it's giving us a true picture of the performance of the organization. Asset has been recognized, liabilities has been recognized, and this is going to be helping us to manage our assets very well and also manage our cash very well because we know that we have obligations that we are going to be settling. But just that is going to be time wasting. It is going to be expensive because we need to now have an asset register. We need to now have a lot of database to be able to apply this. We also have to employ people with the expertise to help us do this. We are going to be valuing our assets now. So we come with valuation of assets. And this is going to be coming with a lot of issues, and that is going to be involving money, but it's going to be giving you information on your liabilities, how to manage your liabilities, how to manage your assets. But it's going to be time wasting. It's going to be expensive. You have to employ people with the expertise to do this. You also have to train people. You also have to train people to understand the accrual basis, and it is going to be very difficult to be understood by a normal taxpayer. We are in the public sector, and telling your mom that, or telling your grandmother who has a zero knowledge in public sector accounting that, okay, this particular item, we are having it over here, although we have not paid, but we are having it over here. Okay, this particular figure over here is relating to the consumption. We are buying this particular asset for 10 years. So we are saying that, okay, how much are we going to be using every year? So we are spreading the cost over 10 years. No, this thing will be very difficult for them to understand. Okay, so you can check they will always give you an items that you have to use to what to differentiate between these two. But if you come to the public sector, we also have other techniques that we use in what in reporting or in recognizing certain transactions in the public sector. And these are one of them is what we call the fund accounting. Okay, we have the fund accounting, we have the commitment accounting. This is only applicable to the public sector entities. So we have the commitment accounting, and we also have the appropriation accounting, or we have what we call the budgetary accounting. Okay. So we have the appropriation or the budgetary accounting. So you also have to check for this one because these are specific what techniques for only public sector entities. And so if you come to the public sector, you see that we have funds that are being established. Yes, yes, please. So we can have the vote or the budgetary or the appropriation. Okay, so you can still have the vote. The vote is the same as the appropriation and also that one. So let's come to the fund accounting. Okay, so in the public sector, we know that, okay, our constitution is giving us two types of what? Funds. We have the consolidated fund, we have the contingency fund, and we also have other funds that are going to be what? Established by parliament in consultation with the what? With the act. Okay, and those funds are going to be administered by a person. So we have the district assembly common fund, we have the sinking fund, and this money will be allocated into those funds. Okay, so we need to be what? We need to account for those ones. So we now establish the fund will be seen as a specific entity on its own, and that will be having administrator, and administrator will be what? Will be reporting on these ones. Okay, so if you come to the fund accounting, we are going to be recognizing items that are going into that particular fund that has been established and the items that are going out of that particular one. So you'll be reporting for the fund. What are the items that are coming in and what are the withdrawals that are coming from that? You have to prepare a statement and submit it to whoever is responsible for managing or ensuring that that particular funds are being used very well. So we report based on the fund. So we are going to be having funds that are being established. Money will be coming into that particular fund and money will be going out of that particular fund. And you have to now prepare a statement or a report on that particular one. So the statement that you are going to be preparing on that particular one is what we call the fund accounting. You are accounting for that particular fund. The fund is seen as a single entity. It's seen as an entity on its own. The fund is seen as an entity on its own. So there are a lot of funds under this one. We have the sinking fund, we have the district assembly common fund, we have the road fund, all the funds that you know, they are going to be what? We are going to be accounting for them one by one. Well, how do we account for this one? It is always in the receipt and what payment formats. So what are the receipts that are coming in and what are the payment that we are making? Okay, so you report for the fund, and the fund is going to be having an administrator who will be in charge of what, whatever is going on there and whatever is going out of that particular fund, and the person has to report on it. So we have what we call the fund accounting. We also have commitment accounting. Okay, commitment accounting. Okay, commitment accounting, what happened is that we are going to be making commitments. Okay. Commitment means that, okay, you are making a promise or you are entering into an agreement for something that maybe you are here to pay for that. Okay. Mostly if you come to the public sector, mostly the district assemblies, what they do is that they can enter into a transaction with what? With a supplier that, okay, in 2 months' time, you should supply us with what? A computer of this amount. Okay, we have entered into a transaction, we have made a commitment. We are committed to a transaction now. So as soon as that particular commitment, that promise has been made, you have to make provision for that particular one. So you have to set aside funds for fulfillment of that particular promise or commitment. So for commitment accounting, transactions or items are being recognized when a commitment or when a promise or when agreement is being reached between an entity and maybe a supplier or whoever is going to be giving something to the entity or to that particular organization. Okay, so we commitment. Okay, we have entered into a transaction with somebody to what? To supply 30 computers to us. The computers are here to be delivered, but we have just reached an agreement that this will be what? Will be transferred to us. Okay, under the accrual basis or cash basis, we need to pay for that computer before we can recognize, or we need to receive that computer before we can recognize under the cash or accrual basis. But for public sector, since you are always going to be operating within expenditure limits, you have to, as soon as you have made a decision, to this particular item, please set aside money for that particular decision so that you know how you're going to be spending the money that you have available for whatever you are going to be doing. So whenever a decision is being made, we recognize a transaction. Whenever a decision is being made, we recognize a transaction for that particular, or we set aside funds for that particular transaction. Okay, and this will also help the reason why is that it will help us to avoid overspending. But one of the issue is that it will lead to end of year or it will lead to a rush spending. So what people will do is that you have to know that you are going to be given appropriations from the consolidated fund or from the national budget, which will be approved by Parliament. So what people will do is that, okay, you know that if you are not able to spend the allocations or the appropriations given to you, this money must be returned back to what? Back to what we call chest, must be returned back to the consolidated fund. So what people do is that at the end of the year, there will now be rushing to make what? To make payments. So it can lead to end of year rushing to make payments. Okay. This is also based on it is based on a mere decision, which in actual case might not happen. So why should you be recognizing a transaction on just a decision that you have the possibility of deciding whether you should go ahead with it or you should not go ahead with it? So the commitment accounting does not apply with modern accounting policies or basis. No, it's just based on a mere decision. It is going to be in contrary to accepted accounting policies. So how can you recognize a transaction based on just a decision or based on just an agreement, which you have the possibility of deciding whether you should go ahead with that or not? Okay. Then we come to what we call the appropriation or the budgetary or the vote accounting. Okay. So we know that most of the public sector entities are being financed from the appropriation being made by Parliament. Okay, these appropriations are going to be given to the public sector entities based on a certain criteria. Okay, so we are now giving you allocations. At the end of the day, you have to prepare a report telling us how the amount has been spent. and what the amount has been spent on. You have to now give a report to wherever this particular money is coming from. So this is also the reason why sometimes you prepare a financial statement together with the what? With budget what? Information. Because the budget is the allocation that will be given to you. Okay, so you have to now prepare information in a budget form. You have to now add budget to the financial statement that you are preparing. So with the budget, we can know that, okay, this is the money given to you, and this is the actual amount that has been received. So the appropriation, which we also record a vote, which is going to be, Parliament will be voting for that particular disbursement. After the disbursement is being done, we are expecting you to come and give us accounts on how those money are being spent. And this will always be in this particular accounting will always be presenting the information in a budget form. So what is the allocation given to you? What is the money given to you? And how is this particular amount of money being spent? You have to now present information and give it to whoever is responsible for the purpose of accountability. And this is why the Minister of Finance has to prepare a budget, a national budget, and give it to Parliament. They have to do end of year review, or they have to do mid-year review. It's because of the appropriation accounting. We have given you money, we have allocated funds to you to use. Come and tell us how this money are being used. Okay, so we also have what we call the appropriation accounting. You have to really look at them and try to see if you can be able to get the meaning out of them, their characteristics and other issues. There will be a 10 marks question, which will be question 1A for the accounting policies and concepts. It's always about the accounting basis. They can ask you about advantages. They can ask you about the differences, giving you certain items that you should use to differentiate between them. All right. All right. So let's look at, these are some of the things that I can say about the accrual, the basis of accounting policies. Let me just talk about the conceptual framework. Then we try to pick some questions on that, and we call it conceptual framework. Okay. All right. We know that public sector accounting too, they have reporting standards. Okay. Whenever you have a transaction, you can make reference to what? A particular standard and what apply it to that particular transaction. But what if there's a transaction that is happening, but that particular transaction is not captured by a specific standard? Example, let's come to a situation where public sector entities or district assemblies or the local assemblies are now doing what we call swapping of what? Of employees. So instead of government employing new people, government will now move people from different assemblies to what? Like we have the normal transfers that we do. Okay, so instead of government now employing people, government can now enter into agreement with what? Other countries and say that, okay, we need an IT person, but we don't have an IT person. Okay, Nigeria, let's say Ghana and Nigeria. Okay, they are all public sector entities. Okay, it's between the government of Ghana and the government of what? Of Nigeria. So now, Nigeria, they need what? They need IT people. Okay, Nigeria can never need an IT people because those people, they are very good with the IT. But they need an IT people, and they don't want to employ, or they don't want to engage the service of what, especially from outside. Okay, they are convinced that Ghana is very good in IT, but we also need, let's say we also need lawyers. Okay, let's say we also need lawyers, and Nigeria, they are very good in, if you count to lawyers, they are very good in law, they are very good over there. So what we do is that government of Ghana and government of Nigeria can enter into agreement where we are going to be giving the IT people to Nigeria, and they will now give us the lawyers that we need. That is a swapping. Instead of us employing people, we have now done a swapping of what? Of employees, or a swapping of what? A workforce. Okay. This particular item is not going to be recognized by, or it's not going to be captured by any particular what? IFSAS, any particular public sector accounting what? Standard. Because the standard is being issued to take care of what? Sensitive what? Items. Issues that are of public concern now. That is what they are going to be, what they are going to be issuing standards for. Because we cannot leave these issues to the judgment of what? Individuals. It is going to be providing misleading information, because those people are going to be accounting for this. Those people, they are also going to be accounting for this based on their own judgment. And that is going to be bringing an issue. So we need to issue a standard to regulate that. Okay, but let's come here that it is not common. It is not common between entities or between public sector entities that they are swapping employees. This is not captured by any what? Any specific standard. Okay, how do we account for this? You cannot just stand up and say you are going to be accounting for this based on your own knowledge. No, you have to make a reference to a particular point. You have to make a reference to a particular point that is going to serve as a guidance on how to account for that. And that is what we call the conceptual framework. So the conceptual framework is being issued by the board, the International Public Sector Accounting Standard Board. To what? To as a supplement to the standards. So the conceptual framework, you only make reference to it where there's a transaction that is not what? That is not covered by a particular standard. For you to develop accounting policy to account for that particular standard, or for you to account for that particular standard, you have to make reference to the provisions that are under the conceptual framework. So the board knows that, okay, it's not all issues that are happening in the world that will be captured in the standard. We only issue standards based on what? Sensitive items, issues that are of public concern. We only issue standards to those issues that are common. There are some issues that are not going to be covered. Okay, if you encounter those issues, what are you going to be doing? We can't leave that particular treatment in the hands of everybody. So we need to now have an alternative to whatever the standard will not be, what will not be covering. So they have issued the document that we call the conceptual framework to supplement what? The International Public Sector Accounting Standards. So this is just coming in as a guidance to a situation where a specific standard cannot be what? Cannot be applicable. Or even if you are preparing the financial statement, what will be the reference? How should the items be presented? Every item that you are going to be seeing financial statement should be under a particular heading. So the conceptual framework is just coming as a guidance on issues that are not going to be covered by a particular standard. And if you want to report if you want to record that particular transaction, you can't use your own judgment. Make reference to what the conceptual framework is saying. That particular item will either be an expense, will either be an expenditure, will either be an asset, will either be a liability, or will either be an equity. What are the situations where you can say this is an asset? You have to now look at that. That is about the conceptual framework. So the conceptual framework is a document issued by the International Public Sector Accounting Standard Board to serve as a guidance on issues that are not covered by what? IFSAS, a specific IFSAS. So we have the rule of this one. The rule of the conceptual framework is not there to what? To override whatever treatment that is covered by IFSAS. So if a transaction happened and IFSA is applicable, you apply the IFSA. The conceptual framework will only come in as a guidance on issues that are not covered by the IFSA. So included in this document, we have the objective of the board itself. The objective of the board is that they should issue quality accounting standard for public sector entities. They should also ensure acceptance and also they should ensure acceptance and also convergence of what these particular standards, and they should also promote publications or studies, or they should also publish articles or studies that support the promotion of the IFSA. So they can ask you about the objective, the mandate of the board. The mandate of the board is, the first mandate is to issue public sector accounting standard boards, or they should issue public sector accounting standards. Okay, that is their first mandate. The mandate is to issue public sector accounting standards to address what new items or new transactions or new issues that they think need to be addressed by the board. They should also, as you are issuing the standard, you cannot just issue the standard like that. You have to make sure that the standard is being accepted and is being applied by what most of the public sector entities that are reporting on accrual basis. Okay, the next one is that they also publish what documents or studies that support or promote the application of the public sector standards. Okay, so if we have any article that is talking about, okay, how this particular public sector should be applied, that is going to be helping people in the application. So we have to promote that, and we also have to publish that particular. The standard will come. The standard will come first, but the standards are being developed from the conceptual framework. Okay, so the conceptual framework will be there. And if you want to develop a standard, the standard will be developed from the conceptual framework. So basically, we can say that the conceptual framework has always been there before the standard. Because any standard that will be coming in, the standard will be developed, making references to the conceptual framework. Okay. So we look at, but the important thing that we are going to be looking at over here is what we call the qualitative characteristics of financial information. Okay, this is one of the areas that they can examine you on. We also look at the elements of financial statements, which are going to be the assets. You also look at the uses of general purpose financial statements or reports. Then you also look at their informational needs. You also look at the measurement basis for the elements, and I'm sure these are the basic areas that they can examine you on, but we have a lot of issues there. We can also have the benefits. Okay, the benefit of adopting IFSAFs. They can also examine you on that benefit of adopting IFSAFs, and also maybe you can also have the challenges, the implementation challenges of IFSAFs. So, or the accrual basis. Okay, so benefit of adopting accrual basis, which is basically you using the IFSAFs, or the challenges of implementing the accrual basis. Okay, so they can try to examine you on these areas for 10 marks. The first, the common one is the characteristics. Okay, what are the characteristics, or what are the attributes that a financial information should have? Those are what we call the characteristics, but these should not be quantifiable. Okay, they are qualitative. Okay, they are qualitative. So these characteristics can be grouped into two. We have the fundamental and we have the enhancing characteristics. Fundamental are those things that, okay, even if you haven't done anything, every financial information should be having that. That should be basic. Okay, we have the basic characteristics, which we call the fundamental. Okay, if you are giving any information out, you are not giving the information out just for you want to give information out. You are giving the information out because the people need that particular information. The information is relevant to them. They can use that particular information to make what important decisions. And this information that you are giving out, you are not just giving the information out because you want to give information out. You have to give accurate information. You have to give information that are free of bias. You have to give information that are free from errors. So without stressing, without doing anything, any statement that should be put up there should be free from error. Any statement that they are going to be putting out there, whether you are putting it on time or whether you are not putting it on time, it should be relevant to the people. People should actually need what? The information for the purpose that they want to use the information for. The information should be given for that particular purpose. The information should be free from errors. It should be free from what we call material misstatements. It should not be 100% accurate, but at least it should be 90 or 95 words. Everything over the 95, because we have issues of materiality there where you have been making judgment as to, okay, this particular transaction is not material. So we cannot include that. But the information should be 95%. It should be reliable. We are not talking about 100% accuracy, but that particular information should be given so that if it's being used, it will not affect whatever decision that these people are going to be getting. It should be free from material misstatements. It should be free from material misstatement in a sense that it will not affect the decisions that the people are going to be, or the inclusion or the exclusion of a particular item will not affect or will not have a greater impact on the decisions that the people are going to be making from that particular information. Then we look at what will now make the information more useful. Okay, what will now make the information more useful? The information can be relevant. The information can be represented faithfully, which we call a faithful representation. Should be free from error, should be free from bias. You should not use your personal judgment. You should not use your personal interest in preparing the information. Okay, and it should be of material errors or any other thing. Okay, these are the fundamental ones. Relevance, faithful representation are the fundamental ones. If you come to the Hansen, so let me write the fundamental ones here. Fundamentals, we have the relevance. The relevance means that the information should be given for the purpose that people need it. And people can use this information to predict what is going to happen in the future, what has happened already. They should confirm what has happened already and what is likely to happen and what is likely to happen today. So the information with relevance should have a confirmative and also a predictive attributes. People should be able to use this to predict what is going to happen in the future. And they should also be able to use that particular information to confirm why this particular thing has happened and why this particular thing is happening now. So it should have a predictive and also confirmatory value. It should be given for the purpose that the people need it. That's what we mean by the relevance. I cannot be needing information about investment in equity. You'll be giving me information on investment in debt. No. That particular information that you are giving to me is not relevant to me. Although everything about it can be perfect, it can be given on time, everything, it can be verified by a third party. But the purpose for which I need that particular information, no, I cannot use it. So that particular information would deem not to be relevant or would deem not to be relevant to that particular user. So the information should be given for the purpose that they have been needed for. And this information should have what we call complementary and predictive values. All right. Then if we come to the faithful representation, we are talking about faithful. Okay, you should be faithful. Faithful presentation, faithful representation. The word is self-explanatory. Faithful. Everything that you are going to be putting up there, you should represent their form, their value, and their nature. They should be classified correctly. They should be free from error. No personal judgment or interest should be factored into the information that you are giving out. Because I'm your cousin, the kind of information that you are giving to me is different from someone else. No. If it is 100 cedis, give us all the information on the 100 cedis. Information should be given which will be free from error, free from material misstatement, free from personal interest. That's what we call the faithful representation. Just put the thing over there the way it is. That is it. You shouldn't hide anything. You shouldn't add anything. Okay, these are what we call the fundamentals. Any information that will be put up there will be relevant. If it is not relevant, it will not be given in the first place. If it is free from error, people, they have reputations to what? To protect. They will not give it out. So whatever is going to happen without any effort, financial information is going to be having these two. These are the basic ones. But what do we make, or what do we have to do to ensure that the information is now more useful? You can give out an information that is free from error. You can give out information that is relevant, that is serving the purpose that the people need it for. But the question is, when does these people need the information? Timing is also important. They need the information within 30 minutes. You are now giving them a very correct information, a very relevant information, but this information was not given on time. So if the information was not given on time, it means that this information will not be useful, because the decision that we want the information for has already been taken. We need the information within 30 minutes. Now you are giving it in 1 hour time. It is not relevant to us. It is not useful to us again. So what are the things that we have to do to make the information more useful? We need to add certain things, which we call the enhancing characteristics. For the enhancing, we talk about the issues of time. Okay, the information should be given as at when it is being needed. But because we need the information, you should just give out any information at all. No, it should be a relevant information. It should be represented faithfully, and it should be given on time. So information should be available as at when it is needed. And that is why you see that companies or public sector entities will be presenting information on monthly basis. They will present information on quarterly basis, on yearly basis. And that is why we have the issue of yearly presentation of financial statement. We want to, whatever is happening during the year, at the end of the year, within 12 months, you should be able to put this information together and give it out to people. Okay, so information should be made available as at when it is needed. We need information within the next 10 days. It should be given within the 10 days. It should not be given after the 10 days. If that is happening, it means that the information is lacking the qualitative characteristics of the timeline. Okay, we also have what we call the information should be comparable. So we have issues of comparability. We have issues of comparability. Comparability is that we should be able to find difference or similarities between the information that you are giving to us. So the comparability is always achieved by consistency. Okay, if you are giving us information on your assets and you are using different accounting policies, okay, you are using, let's say you are using cost model. In the first year, now you are using revaluation model. How do we identify the increment in these figures? How do we identify that the increment in the current year asset is as a result of what? Addition of assets. How do we determine that? So for us to be able to compare, for us to be able to identify the differences between two items, you need to be consistent in whatever you are doing with those items. So if you are giving us a PP figure for this figure, we should be able to compare with what? With the current year or with the previous year, because you are using the same accounting policy. So we find the difference. We know that, okay, this particular difference is as a result of the consumption of the fixed capital, or is as a result of acquisition of a new item. The situation where we cannot identify the differences, or you are giving us an information without any prior year information. And for the purpose of the comparability, that is why you see firms presenting current year financial statement with what? the last 2 years or most at times the last year information. It is for the purpose of comparability. We should be able to compare the information internally. We should be able to compare this information also with what? With a similar organization. So the information that you are giving to us, it should be able to be should be compared with other information of the same nature. It can be we are comparing the performance of what? Different entities, or we are comparing the performance of what? The same entity for a different period. And the comparability helps us to do our ratio analysis because we assume that all the entities are using the same accounting policy. So if you're using the same accounting policy and you are within the same industry, it means that we can actually compare your performance because you are using the same policy. We can be able to identify why this is happening, why this is not happening. Okay, and the comparability also in the public sector, we also ensure the comparability by adding budget information to the what? To the reports. So they can tell you that, okay, the company has added a budget information or has included a budget information in the financial statement, or budget information has been added to the financial statement. That is for the purpose of what? Comparison. The budget is going to be giving us our estimate for the year, and the actual will be presented in the financial statement. So we look at, okay, how much do we say we are going to be spending on this and what has been spent? So we cannot compare and look for the variances. So the comparability has to do with you giving out the information that can be compared to the same information of a similar organization or the same organization, but for different years. But if you want to do this, you have to be very consistent in whatever you are doing. The consistency helps us to achieve what? Comparability, but consistency is not comparability. Consistency has to do with you doing the same thing for a particular period of time. Consistency in application of accounting policy. If you're using cost model, apply the cost model for a number of periods. And this will help us to compare performance over years. This will help us to identify why this is happening and why that is not happening. So we have the issue of comparability, and the question will always tell you that the company has included a budget information in the statement. Which kind of or which type of the characteristics that they are trying to achieve over there, it will always be the comparability. The budget will help us to compare our actual performance with the what? With the budget information, or the actual information with the estimate that we have at the start of the year. Okay, you can also have the issue of what we call the verifiability. Please, how do you write verifiability? Verifiability. Okay. Verifiability has to do with, okay, before you can use the financial statement of any entity, at least a third party should be able to confirm. That's why we have the audited reports. So if you see an audited report of an entity, okay, you are very much convinced than an audited report. So you can see that, okay, these people has been audited by Deloitte. So it means that whatever is being presented in this particular financial statement is correct or is not correct. So verifiability has to do with, we should be able to confirm. We should be able to confirm the authenticity of this particular information. This confirmation can be done by ourselves, or it can be done by by a third party. There should be an information to be able to verify. So adding a footnote to account is for the purpose of verifiability. So we can go there. You are saying that revenue, IGF, okay, direct taxes, note 2. Okay, we can go to the note 2, pick the figures one by one, add them to verify if the figure that you have presented over there is what is correct. So we can do the verification by ourselves by adding up the figures or performing the procedures that has been done to arrive at those figures. So we can add by ourselves to verify, or we can reperform the procedure that has been, or the method that has been used to arrive at this figure. So we can verify this by ourselves. We should be able to verify whatever is going to happen or whatever information that you are giving out there. We should be able to verify it by confirming that by ourselves, by calculating or by reperforming whatever process that has been performed in arriving at that figure. Or we can also rely on what? On the opinion given by a third party. On the opinion given by a third party, an independent third party. Or if we take the information, two independent individuals or two independent third party should be able to form what? A similar, or should be able to arrive at a similar conclusion on the information that you are giving to us. So it should be verified. Verified means that it must be signed. That is by a third party. It should be audited. A third party, which is not related to the organization, an independent third party should tell us that, okay, this information is accurate. Another independent party should also tell us this information is what? At least two individuals, two independent individuals, third parties should be able to reach the same conclusion or similar conclusion on the information that you are giving to us. If we cannot rely on the information, then we can do the verification ourselves by adding the figures, reperforming the processes and everything. So the information that you are going to be giving to us, it should be verified. There should be a signature on the information that you are giving to us. You are giving information to me. Who prepared the information? You say yourself. Okay, who supervised or who reviewed this particular information? You say nobody. No, I cannot rely on that particular information because it is not verified. So adding footnotes to account is for the purpose of what? Verification. So they can give you that, okay, the company has recognized this, but there's no documents or there's no supporting documents. It means that that particular item is lacking the what? The characteristics of what? Verifiability. We also have issues of understandability. The information should be presented in a way that it should be understood by what? A mere taxpayer. You should not be using plenty grammar. We are in Ghana, and if you want to present an information, the information should be presented in English and also maybe presented in what? In a language that is generally spoken by what? By the citizens of Ghana. If you are a Chinese company and you are in Ghana, you're operating in Ghana, you cannot present your financial statements in what? In your language, in Chinese. We cannot understand. So you have to present in both the Chinese language for those who can read and also the language that we also understand. So the information should be very precise. It should be concise. It should be presented in a way that it should be understood by what? Someone who has no knowledge in accounting. The person should be able to do that. And that's why we have the format for accounting. And that's why we do what? The notes. Because if we should bring all the items, it's going to be plenty. So let's just bring the information there. If you want to verify, if you want to understand, if you want to confirm, you can go to the notes and look at, okay, how this information is being what? Is being arrived at. You can also do that. Okay, so situation where the information is being prepared in a language or in a format that is easy to understand, we say that, okay, that information is having a characteristics of what? Understandability. So those who are going to be using the information, they should be able to understand. How do they understand? Presenting information in a simple format, in acceptable formats, and people that are going to be using this, people that are going to be reading this, they should be able to. Don't say you are calculating for revenue and you are using tan theta dy over dx. No. How do we understand this? The information should be arrived at using a simple format, a simple means of what? Getting those information or those figures. It should not be complicated. We should be able to comprehend whatever is there. Even with the accounting background, we should be able to understand. And someone with no accounting background should also be able to understand that particular one. We also look at the elements of financial statements. For the characteristics, they can give you a statement on its own. And they will omit certain items and they will ask you to identify some of the characteristics that this particular statement is having and some of the characteristics that this particular statement is not having. You should be able to identify that. We also look at the elements. The elements are the asset, liabilities, their recognition criteria, and all those things. Users. or the general purpose financial report. What do we call the general purpose financial report? A report that is being prepared and published in the public domain. It is accessible to everybody. That's what we call the general purpose. It is being for everybody. It is serving a general purpose. But we also have what we call a special or specific purpose financial report. This is going to be for a certain group of people. It is going to be given to people who has the right to request for what? Such information. So example of those people will be the parliament. Parliament can now require a district assembly to present information to them on this, which we, the individuals, the mere citizens cannot request for. So the general purpose is for everyone, but the specific is for a particular group of people who has the right to request for such information. So we also come to the measurement basis. If you want to recognize an asset in the books, how do we measure it? We can measure the asset based on the costs, okay, the amount that we have purchased for the amount that we have paid for that particular asset, which we call the historical cost. We can also measure the asset based on the current value. What is the value of the asset currently? We can also measure the asset based on the fair value. If you are receiving an asset from donation, you are not paying anything for it. So how do we measure this asset? We cannot measure this asset at the cost because we're not paying anything for it. But what is the value of this asset in the market? We can recognize that asset at the fair value. We can also use the replacement cost. We can also use the value in use, and we can also use the net realizable value. If you can look about that, we can come to the benefit of adopting the accrual basis. Why are we adopting the accrual basis? Because the accrual basis gives us what? A true picture of the performance of the financial entity or the reporting entity. So we'll be looking at the adopting the accrual basis will ensure what? A greater accountability and also transparency in the public sector. The purpose of public sector accounting is to ensure accountability and what? Transparency in public spending. We just have to make sure that public funds are being used very well. So whatever you are going to be saying, it should be linked to what? Issue of accountability and transparency. That is the purpose of the public sector accounting. We want to ensure accountability because we are going to be using resources of the poor masses, the poor citizens. So they have to ensure that these funds are being used to the benefit of the citizens. So the benefit of this one, we can also, if you're using accrual basis, you can also have access to the capital market. You can also have access to what? Funds. Because if you want people to invest, if you want to go for loan and all those things, people want to know your actual performance. It's not just the cash and whatever is coming in that you are writing off. So it can also give you access to what? It can also give you access to the funds or capital market or the money market. You can actually get money from wherever you want to get money. Okay. It will also give you a better management of your assets. If you are calculating consumption, which we call the depreciation on your asset, you know when to replace your asset. And this is only done under the accrual basis. And this will also improve the decision-making the decision-making purposes of the users. Okay. If you are giving us now a complete information, not only about cash, we can now make a better decision as to the information that you are giving to us. And what are the challenges of adopting the accrual basis? Accrual basis, you know that is going to be requesting for a lot of what? A lot of money. You have to put in a lot of work. So sometimes we need to value the assets. And we cannot, not all the assets can be valued. Let's come to heritage assets. Look at the statue of Kwame Nkrumah. Can that particular asset be valued? Look at the Elimina Castle, the building over there. Can that particular asset be valued? So sometimes it will be very difficult for us to apply the accrual basis. So the valuation of assets sometimes will be difficult. Example is the heritage assets. Asset that we are keeping for the purpose of their culture and for the purpose of their history. We cannot actually value them. Who is going to be purchasing Elimina Castle right now? If you put it for free, nobody is going to be purchasing, but that is going to be giving us a lot of respect. So the value that we are placing on that particular asset might not be actual value. So sometimes valuing those assets will be very difficult, and we cannot use the accrual basis when the assets cannot be valued. The implementation cost also. You need to have a large database for you to be able to do this. You need to have expertise. You need to now do training. Sometimes the expertise are not even there. Sometimes the expertise are not even there. Even those in power, they are not even willing to support the agenda. So sometimes lack of political will or support, because every government have their own agenda. They know that if you are using this particular one, it will expose their other side. So they will not support it. So they will not support it. And there's not even a regulatory body to sanction whoever fails to adopt or to implement the accrual basis. Lack of regulatory bodies. There's nobody there. If we are all moving to accrual basis, if you're not able to apply the accrual basis, you are going to be sanctioned or you are going to be punished. And there will be a body that will monitor the implementation of this. Sometimes there's nobody to do this. If you come to Ghana right now, what is the body that is monitoring they are saying that everyone should now move to, the assembly should now move towards the accrual basis. The only time you are seeing the accrual basis is in the exams that they will give you questions. There's nobody that is saying that if you don't apply this, we are going to sanction you. No, there's nobody. There's no regulatory body. And people are not willing to sanction. The government is not in support. What is the government doing? Are there training? Are there things in place to ensure that these are going to be done? So sometimes the valuation of the asset is always difficult. Example is the heritage asset. Lack of political support or will. People in power, the government, they are not willing to support the agenda. Lack of regulatory body in terms of inability to apply or conform to the requirement they are going to sanction you. There is nobody like that. And lack of, sometimes we need expertise, and expertise are not there. And also the rich database that we need, and also the cost, sometimes we cannot implement so they can ask you about the challenges, the benefits, the measurement basis, the uses of the general purpose financial reports, and you ask you for the informational needs. We have the resource providers, those who provide resources like us. We are paying taxes, so we are resource providers. And we also have the donors. They are also those who give the resources, those who provide resources. So the users can be grouped into three. We have the resource providers. We have the service recipients, those who are only receiving the service. They don't provide resources. And we are still part of it. Citizens are still part of it. Our younger brothers, they don't pay tax. Okay, they don't pay tax. Whatever tax that they are paying it through us, because we are going to be giving them the money. So the value that they are paying, it is still paid by their parents, but they are just receiving the service. What service are they receiving? The government will put up a establishment there, like schools. They will go there and they will learn. They are receiving the service, and they are not even paying anything. That is now is free SHS. And we also have the other parties, which those people cannot be classified as the service recipients, and they can also not be classified as what we call the resource providers. And you also have to look at the informational needs. Citizens, what do we need the information for? We need the information to determine the performance of the government. We need to determine the performance. How are you doing? So you look at, okay, Anando has done better than Mahama. This person has done better than this one. It's because of the information given to us, the data available. We also need the information to determine the service cost delivery. So right now, if you want to go to the hospital, how much are they going to be charging? How do we get this information? We have to get it from the information given out by the hospital. We also look at the parliament is also a user. They also want to ensure the compliance with with the budget. And they are also needing information for accountability purposes. If you haven't done something well, you are coming to meet the public account committee for whatever is going to be happening. So these are the areas that they can examine you on. Please pay attention to the qualitative, pay attention to the measurement basis, pay attention to this one, pay attention to the users, just pay attention to everything. The accounting concepts and policies, the question can be based on you to differentiate between the two based on the particular item, or sometimes they can also give you an item that can give you a statement that you should now change the statement to cash basis, or they should change it from accrual basis to cash basis. The conversion, you can easily change from accrual basis to cash basis. They can also give information on that, or they can give you information on public sector techniques, which is what we call the appropriation, the commitment, and other ones. We have spoken about that. Please, let's pick some 2-3 questions to look at whatever we have done. Auntie Patricia, are you there?
Yes, please, I'm here.
Okay.
Question 1. The Director of Finance and the Principal Spending Officer of a public sector organization are in disagreement as to which basis of accounting will provide the most useful information for the users. The Principal Spending Officer strongly believes that whether an entity applies cash basis or accrual basis, the effect is the same. The Director of Finance disagrees with him totally, arguing that different accounting treatment applies to both and therefore affects the level of disclosure in the financial report. Required, explain the 4 bases of accounting in public sector. B. Explain 2 advantages and disadvantages of cash basis and accrual basis of accounting.
All right. So what are the 4 bases of accounting in the public sector?
Cash
That
basis.
the cash basis, accrual basis, modified cash basis, and modified accrual basis.
Okay, I hope we can actually say something about them on that day, isn't it?
Yes, sir.
Okay. Please don't leave any space. Okay. You public sector, you are also part of the public sector. If you don't understand anything, just know that public sector is all about ensuring accountability and transparency, and also to ensure that public funds are being used very well. Anything that you are going to be writing should be driving towards what? The purpose of the public sector. And don't leave any space and go. No. What you are thinking about is the right answer. Write it and move on. All right. Let's come to explain 2 advantages and disadvantages of cash basis and accrual basis of accounting. Let's take the cash basis. What are the advantages of using cash basis of accounting?
It's easy.
Okay, it is easy to use. Okay.
Transactions are only
It's simple to
recorded when
understand.
it's in the cash basis.
Okay, it is easy to understand. Okay.
Transactions are only recorded when cash is affected.
Okay, that is also fine. Okay. So this one to the cash basis is better for if you are doing budget reporting. So if you are doing budget reporting, we can actually monitor the performance. So it is very important when we are using budget reporting. Okay. So if you're using budget reporting, this will actually determine performance. So how much are you spending? How much are you bringing? So we can actually monitor our budget. And someone saying that it needs only little or no expertise is needed. Okay, that is also fine, because you don't have to. It is also less expensive because you are going to be buying only 1 book for the person. Whenever you have paid cash, put it here. Whenever you have done this, put it here. It's not accrual basis that you have to train the people and those kind of issues. But what are the disadvantages of using the cash basis of accounting? The
It
disadvantage.
doesn't help us to assess the general performance of the organization or the entity.
Okay. Okay. So assessing the performance of the entity, it cannot give you a true picture. It does not give us a true picture or a true measure of the performance of the public sector entity or the reporting entity. Okay, that is cool.
It also make us difficult to find the final decision, to make final decision based on a cash basis.
Okay. Okay. So it records capital assets as expenses. There's no recognition of assets apart from cash and cash equivalents. Okay. It does not recognize liability, and it does not present any distinction between capital expenditure and revenue expenditure. Okay. So it gives room for misuse of what? Resources. Okay. That is fine. It gives rooms for misuse of resources. That is fine, because you can only recognize the transaction when cash has been what? Cash has been paid. So sometimes we don't need that particular information, but because we don't need that particular item because we want to spend the money, we can go there and buy any item and put the records there. Okay. Let's come to accrual basis. What are the advantages of the accrual basis? Okay.
There are disadvantages of cash.
Okay, so the disadvantages of the cash basis will give us the advantages of
accrual.
and advantages of the cash basis will give us what? The
disadvantages of.
Okay, so you can just rewrite those ones. Auntie Patricia, question number 2. First.
Question 2. The conceptual framework can provide guidance in dealing with financial reporting issues not dealt with the ISAPs or RPG. In these circumstances, preparers and others can refer to and consider the applicability of the definitions, recognition criteria, measurement principles, and other concepts identified in the conceptual framework. Required: explain 5 qualitative characteristics of the general purpose financial reports. B. Explain the 2 benefits and 3 challenges the adoption of IPSAPs as a framework for financial reporting in Ghana. C. Explain 4 key elements of financial statements and detailed their basis of recognition in the financial statements. D. Identify 4 characteristics of government business enterprises according to IPSAPs 1. Presentation of financial statements.
All right, thank you. Okay, so let's come to the characteristics of general purpose financial report. Characteristics of general purpose financial report. What are the characteristics?
Principal representation.
Okay.
Relevance.
Okay.
Understandability, comparability, verifiability.
Okay. So
and timeliness.
Okay. I hope we can actually say something about them. All right.
Yeah.
So let's go to explain the 2 benefits and 3 challenges of adoption of IPSA as a framework for financial reporting. I hope I've already answered this question.
Benefit here, ISAPs.
Okay.
Accrual concepts.
Okay. So can we still say something about them, maybe as a way of revising the benefits?
Application allow us to compare performance over regional or local basis.
Okay. That is one. Using the IPSAFs, the comparability is very simple. Okay.
Like we said, it gives measure.
Okay. That can also give us a better measurement of the performance and also a proper management of our assets and liabilities. Please, if they are talking about the IPSAFs, they are talking about accrual basis. All IPSAFs are being developed based on accrual basis. Okay, so if they are saying adoption or the implementation of IPSAFs, they are talking about the accrual basis. Okay, so it can also help us to have access to funds from maybe capital markets and wherever we want the funds from. Okay, but what are the challenges? What are the challenges? Please, they can ask you on the challenges because Ghana, we are having a problem in adopting the IFSA. So the challenges can be an important area for examination. Okay, so we
Lack
have
of
a problem with the implementation. So they can,
lack of expert knowledge to implement.
okay, lack of the expertise.
Lack of
is not there.
political will and support.
Lack of political will and support is also there.
And lack of expertise.
Okay, the expertise are also not there. And we don't even have a regulatory body to ensure the implementation. And sometimes the valuation of our asset is also
Difficult.
it's difficult in terms of some of the assets. Okay, sometimes it's not consistent with what? With the national legislations. Okay, we are saying that we should be using commitment accounting. No, you are now saying that we should only recognize a transaction when it is being earned or when it is incurred. So it means that the commitment accounting cannot actually be applied again. And we also want to do what we have for ourselves, so we can ignore the implementation. So that has to do with the inconsistency with the local laws or the national legislations. Explain 4 key elements of financial statements and detail their basis of recognition in the financial statements. Okay, elements of financial statements.
Assets, liabilities,
Revenue,
and
expenditure,
expenditure.
Capital input.
equity.
Okay. Okay. So I hope we can detail their recognition, isn't it? Recognition criteria.
Yeah.
Okay. So the recognition criteria is just like the recognition criteria of asset that you know in financial reporting. It's the same as the conceptual framework for public sector is the same as it's almost the same as the conceptual framework for financial reporting. Identify 4 characteristics of government business enterprises according to IPSA 1, presentation of financial statements. What are those entities that are classified as government business enterprises?
Those that have autonomy to transact business on their own accord.
Okay. So we have the issues of the ECG, the Ghana people, the Ghana Water Company people.
Ghana Water.
I learned that those people, they are chopping.
But you've been an auditor before, haven't you audited them before?
No. We didn't have they have been sharing this thing. They have been sharing their work. So for us, we don't have the opportunities. I only experienced auditing of schools and the district assemblies and also the hospital. Those people haven't been there before. Those one they have been given to another group or another team. So the court, those circuit court and those people, they have been examined by different people. So me, I didn't examine them before. Okay. But I learned that they do pay themselves. Any organization that is paying themselves means that they can do everything. Okay. So that is nice. They are doing well. I also get this thing over there. All right, let's come to the government business, or they are also called the state-owned enterprises. They operate as if they are what? They are commercial entities. They operate like a commercial entity, and they are always established under the what? The
Companies Act.
Okay, they will be established under the Company Act. So they operate like what? Like a private entity. Okay, and the question is, what are the things that you have to notice? What are the things that you have to see before you know that, okay, this particular entity is what? Is a state-owned enterprise. That is what they are looking for. Okay, so we are going to be looking at the characteristics of a state-owned or a government business enterprise. Okay, what are some of the characteristics?
They don't rely on government subvention to be a going concern organization.
So they don't actually, before they can operate into the future, they have a means of what? ECG right now, we are paying them electricity bill, we are buying the prepaid. So even if government is not giving them any support, they will still what? They will still operate. So they don't rely on government support or government subventions to operate on a going concern basis. Okay, that is cool.
They are granted power to contract on their own name.
Okay, they have the power to contract their own name, so they can go into a transaction as on their own. Whatever is going to be happening, they have to face it on their own. Government supposed not to come through for them, so they are given the power to contract in their own name. All right.
They are assigned financial and operation authority to carry on business.
Okay, so they are being given the financial and operational authority. So the financial authority is that you can generate your own revenue. How do you generate your own revenue? You have to charge people fees. That's why the ECG and water company, we are paying the bills to them. So they have the power to what? To charge those fees, and they have the power to buy whatever equipment that they need to what? To transact their business. So they are given the operational and financial authority power to carry on business. They can determine their own price. They have to purchase their own assets, not the government giving them cars and right on it donated by government of Ghana. No, they can purchase their own cars, and do their own transactions. So they are given that financial authority and operational authority to carry on business. Okay. What again?
They sell goods and service. They sell goods and service on the normal course of business to other entity.
Okay. So they sell goods and services in the normal course. They operate like normal entity, and they can also charge any fee that they want. Okay, they can operate at a profit. So they can charge any fee that they want. They can operate at a full recovery cost, which is the cost plus the profit margin that they are charging. But whatever be the case, their boss are being appointed by who?
By the government of the day.
By the government of Ghana. So they are
Okay.
controlled by the PSC.
Okay.
Public sector
So
entity.
at the end of the day, although we are giving you all these things, but they are still controlled by what? By the public sector or the government. Okay. So please, this is also an examinable area. But the advice that I'll give to you is that we'll still be looking at it, but as we are looking at issues, I will also tell you that, please, you can go back to 2015 and look at some of the questions there, especially theory questions there, and maybe they can repeat them because the public sector is different. So they cannot bring public sector questions from Nigeria to Ghana. No, but if you come to financial reporting, they can bring all those ones, those common ones. They can lift questions from other professional bodies to examine over here. So let's see what we can do on this particular one. Okay, try to make sure that you understand every issue about the conceptual framework and also the accounting policies. They are going to be for 20 marks. Okay, and you cannot afford to score less than 10 marks in that particular question number one. It will go against you. Let's come to question number 3.
Question 3. Until recently, government largely provides financial information to users on cash basis. However, there has been mass movement away from cash basis to accrual basis in recent times, triggered by the adoption of accrual basis PSAFs. Many public sector executives with no accounting background failed to see any need for such movement and described it as time and money wasting exercise. Your principal spending officer also belongs to this school of thought. Required, as the accountant explained to principal spending officer, compelling reasons why government departments should report on accrual basis of accounting.
All right. What is the requirement of this question? What are they asking you?
The benefits of accrual basis.
Okay, the benefits of the accrual basis. Or you can talk about the disadvantages of the cash basis and now use the accrual basis to counter whatever you are saying there. So they are just talking about the advantages or the benefit of using the accrual basis. Okay, so you use it because they are in support of the cash basis. You use the accrual basis, whatever you are writing, to cancel the cash basis out. So you use it as a counter to the cash basis. Okay, so that is what they are actually asking you over there. Okay.
Question 4.
Okay.
National Happiness Department is a new covered entity established to promote healthy living among Ghanaians. The principal spending officer is aware of the requirement for every covered entity to report annually on its financial affairs in accordance with the International Public Sector Accounting Standards. Given the structural arrangement of the department in the scheme of the public sector, the principal spending officer is not sure if the department qualifies as reporting entity under the conceptual framework of the general purpose financial reporting. He therefore seeks your advice as an accountant. Required: explain to the principal spending officer what constitutes a public sector reporting entity under the conceptual framework. B. Explain key characteristics of a public sector reporting entity that you would consider as the basis of your advice to the principal spending officer of National Happiness Department.
Okay. So what is a reporting entity and what constitutes what? A reporting entity.
Any entity that applies general purpose financial. Any entity that prepare financial statement to satisfy the general purpose financial statement requirements.
Okay. So reporting entity is any entity that prepares what? A general purpose financial what? Report for users. It can be any public sector entity that prepares financial reports for users. Okay. And this one, the reporting entity will be any entity that have the responsibility or the capacity to raise or deploy what? Resources. So any entity that has the responsibility to deploy or raise resources will be seen as what? As a reporting entity, because since you are deploying resources, you have to be held accountable for that. Since you're also raising resources, you also have to what? Be accountable for that. How do you show your accountability? You have to now prepare a financial statement that will be needed by the users of that particular money that you are using. Any entity that also acquires what? Or uses public assets. If you are using money to acquire assets, you have to account for it. Or any entity that uses what? Public assets. How are the assets being used? The funds given to you, how are they being what? Used? So any entity that has the responsibility to raise or deploy resources or economic resources will be considered as what? As a reporting entity or any entity that acquires or manage public assets. Liabilities will also be required to what? To prepare a report on these what? These items or these issues. How are the funds being used? How are the assets being managed? How are the assets being used to generate revenue? You have to report on all those things. So any entity that prepares a general purpose financial report for users or for the public is called a reporting entity. And what constitutes a financial reporting entity is any entity. If you are an entity that you have the ability, you have the responsibility to raise or deploy resources. If you acquire or manage a public asset or liabilities, you are going to be required to prepare a general purpose financial statement because these are things that are of public concern. The resources you are raising or deploying the resources to the public. So the public is interested in how these resources are being used and how these resources are being managed. So you have to prepare a financial statement that will be given to all of us. That will be given to all of us. All right. So that is the conceptual framework. That is the reporting entity. What are the key characteristics of a reporting entity? I hope we have looked at these ones maybe once.
They are service recipients or resource providers.
They are
Service recipients or resource providers.
no, they are not okay, but they are entities that resource providers and service recipients are existing for them. Okay, so the word is not there are. Okay, so they are, not they are. Okay, so let me use the word. The word was this one. Okay, the word was this one. It was this. Okay, not this one. Okay, so if it is this one, then it means that the organization itself. If it is this one, that means that we are talking about what? Other people being in existence. Okay, so any entity that is having service recipients or resource provider that depend on their financial statement, we say that that particular entity is what? Is a financial or is a reporting entity. So there are service recipients or resource providers that depend on their what? On their financial statement or depend on their general purpose financial statements for whatever decision that they are going to be making. Okay. What is the other one?
Resources.
Yeah. Or the another characteristic is what?
Sorry?
It raises resources from or on behalf of constituents and uses the resources to undertake activities. Yeah.
I like the way you are taking it from the notes. That is nice. Okay. So any entity that raises resources on behalf of other people and use these resources to what? To provide services to the benefit of this individual, we say that that particular entity is a reporting entity. So you are raising resources on behalf of people and you are using that particular resources to what? To the benefit of those people. At the end of the day, the resources that you have raised on our behalf, you have to what? You have to account for it. Because the resources are not for you. We are interested in how the resources have been what? Has been used. So what do you have to do? You have to prepare a general purpose financial report for all of us. It should be a report that can be accessible by everybody. It should not be for only a specific group of people who has the right what? To demand for those information. Okay. So the general purpose financial, the reporting entities, any entity that prepares a general purpose financial report, and any entity that raises resources on behalf or on their own and use those resources to the benefit of the individuals. Those people have to be what? Have to account to the individuals how these resources has been used. Any entity that is having resource providers or having service recipients that depend on their financial statements for decision making, you can also be called a reporting entity. So if you come to Ghana Health Service right now, we need their information to know whether we should go and do health insurance or we can go to the hospital on our own. Yes. Because we look at the fee. Okay, if you want to do the health insurance, what are the things covered by the health insurance? Okay, you can look at it. Okay, if you want to go to the hospital, how much are they charging now? So you look at the cost and say, no, let me go and do the health insurance. Or even if I have the health insurance, maybe I will not be able to access a certain facility. So let me just ignore the health insurance and use my own pocket to go to the market. Yes, that is a decision that you have to make. And these decisions will be made from the information given by what? By the health insurance or by anyone who supposed to give us that particular information, or the National Health Insurance or the Ministry of Health. Okay, let's come to question number 5.
Question 5. Financial reporting is a means to an end, which is to provide information to service recipients and resource providers for accountability and decision-making purposes. Therefore, understanding the information need of the service recipients and resource providers is critical to useful financial reporting. Required. Discuss 4 main assessments that the primary user will need information in the general purpose financial reporting to make about public sector entity.
Okay, if we take the general purpose financial report, it's just the statement that is accessible in the domain of everyone. So it can be the statement of financial position, statement of changes in equity, statement of financial, statement of performance, or which we call in the private sector profit or loss, but in the public sector statement of performance, or receipt and payments statement, anything that you cannot suffer as a mere citizen, you can just go there and have access. Okay, if we have this information, let's say the statement of financial position, what are the judgments are we going to be making? What are the things that what do we use the financial statement for? The statement of financial position, what is it used for? If you take the financial statement, how do you assess? What will be the assessment that you'll be making from this? Or what is the purpose of the statement of financial position? If you take the statement of financial position, what is the assessment that you are going to be making? If you take the statement of financial performance, what is the assessment that they are going to be making? That's what they are talking about over here. So what are the assessment that a primary user, like the parliament or ask the citizens, what are the assessment that we are going to be making from these statements? That's what they're asking over here. Okay, so the first assessment is what?
Parliament want to know how they comply with the financial regulation, Public Financial Management Act, and other things.
Okay, so we can also use that to ensure compliance with what? Other regulations, or compliance with regulations as regard to budgeting and maybe the reporting. So compliance is also one of the assessment that we want to make. What again?
Citizens want to know how best they put their resources, the tax they paid,
Okay,
into use.
so that is not bad. That's not bad. We are also interested in how the resources are being used. In other words, we are looking at how the entity is performing. Okay, so that is not bad. That is not bad. All right.
We also need to know the liquidity of the government organization.
Okay, so that is, if you take the statement of financial position, our assessment will be what is the financial position. So the assessment over here is also like the purpose of the reports that are being prepared by what? By the public sector entities. If you take the financial reports or the statement of financial position, we want to know the financial position of the entity. Knowing the financial position, we want to know whether the company has cash to be, or whether the entity has cash to be able to settle their liabilities as at when they fall due, or they also have cash to settle their long-term liabilities. So we are concerned about the solvency and also the liquidity of that particular organization. And that will be a purpose of assessment that we can make from the statement of financial position. What about a statement of financial performance?
Whether we are making profits.
Okay, No, this is public sector.
No, sir.
Pu-
The
Public
management
sector is
of
not
the
profit.
resources.
Okay, so we want to
Management of
know.
resources.
Okay, we
We are
want
look
to
for
know.
money.
We want to know
Yeah.
the how resources are being managed. We also want to know that our asset management. So so if you come to the public sector, the assessment that we basically want to make is that we want to know the financial performance of the public sector entity as to whether they have the capacity to operate on going concern basis, whether they are able to utilize their resources to generate a higher return or a surplus that we call it, and other issues. Another assessment that you can also make is the compliance with regulations or the important regulations, compliance with the budget and other issues. So we can also make assessment as to whether the company has the financial capacity to operate or has the financial capacity to provide service for the long term. So we also look at maybe financial capacity. Do you have the resources? Do you have the money to be able to operate, not only to pay your debt? Do you have the capacity to operate for the long term? That is the financial capacity. We can also look at the operational capacity, whether they have we can make assessment as to whether they have the operational capacity. Operational capacity has to do with the resources that you have, not the cash resources. Do they have the assets? What are the assets? What are the structures that you have? What are the capital items that you have? Will this be able to help you provide service to the long term? That is what we want to make. Okay, so the assessment just about the report prepared by the public sector entities. What are the purpose for those particular reports? The purpose can still be seen as the assessment that we want to make. Statement of financial position, we want to know the statement of the financial position of the entity. That is to know their position in terms of liquidity, in terms of solvency. Statement of financial performance, we want to know whether they are making surplus. So we want to know their financial performance as to managing their resources to generate a higher return, having the capacity to operate into the long term. We also want to know the compliance with with the legislations as to the budget and other issues. Those are some of the assessment that we want to make. B.
Please, sir.
Yes, please.
Please, if it's not segmented into financial position, financial performance, do you have to, but me still let your answer to that segment?
No. It's just the assessment, but I'm just saying that the easiest way to be able to get
Okay, you are
assessment
just taking it in that this is so that we can. Okay.
Okay, yeah. Auntie Patria, are you there?
B.
Yeah.
The conceptual framework for general purpose financial reporting provides for inclusion of budget information in the general purpose financial reporting of public sector entities. Consequently, PSAF 24 was issued to provide for disclosure of budget information in general purpose financial reporting. Required. Discuss the benefits of including budget information in the general purpose financial reports.
Okay. So what are the benefits of including budget information in the general purpose financial reports?
It helps monitoring actual performance against budgeted.
Okay. That's not bad.
To ensure comparability too.
Okay. That is what okay. So so monitoring, that will be a control. Comparability will be okay. Okay. The main purpose is for comparability purposes. Okay. So we can actually compare our financial statement, our actual, with the budgeted, and we can also put in measures to control our spending or maybe our revenue source. So that is the monitoring that Senior Philip has spoken about, and the monitoring. So it can help us to control or put in measures that can be used to cut down or to improve upon our budget. Okay. Another one is what? Okay, we have the monitoring, we have the comparison, and what again?
Can you say it enhances consistency? Correct.
Oh no. For me, no answer is wrong. You just have that. You have to convince the examiner why you are saying that. Okay. So if you are not sure, you have to make an attempt so that your pen and your energy wasted in writing that particular point will not just go like that. So you just have to convince us. If you're able to convince us, we accept it.
Yeah, as is used to monitor, corrective actions should be taken in order to achieve objective.
Okay. Is that the explanation to the consistency?
No, I'm bringing another point.
Okay. All right. So Auntie, can you convince us with the consistency?
So I mean that so since consistency enhances comparability, so that's why I made that comment.
Okay. 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 So okay. Okay. So let me try and see if I can get an explanation to the consistency. Okay, it also increases the reliability of the report. That's fine. So we can also use the budget to determine the budget reliability. So the actual against, we say the budget is reliable if the actual performance is 100% the what, or at least 90 something, or is almost the same as the budget. We say the budget is reliable. So we can also use that to determine the budget what reliability. But the consistency, I'm coming to talk about the consistency. Or so the budget will be prepared based on a format, and if we are asking you to include a budget, it means that we will be asking you to using the same format every day. So maybe I can try to attribute that to the consistency, but it will not be a major benefit for the inclusion of the budget one. Can we also say it ensures, should also ensure compliance with legislations?
Yeah.
Okay. So you can,
So, but the consistency that she was talking of,
yeah.
you see, they say we should apply any accounting policy for a number of years, over a number of periods.
Yeah.
So if you are applying it and you are coming to compare, it means it will be in line. As you are setting the budget there, it means you are inconsistent with the application of the policies.
Okay. Can that be consumed into the compliance?
And once you are being consistent with the policy, it means your budget is in line with whatever framework is in place.
Okay. But I'm not seeing the consistency as a major benefit anyways, but that is also not bad. As soon as you are able to convince the examiner with whatever you have, there is no wrong answer there, please. There is no wrong answer. The only time that you have a wrong answer is if it is a calculation. If the answer is 50, is 50. But as far as it's subjective, you have so many ways of what. Yes, so you just have to convince. Don't see the question and say you haven't seen this question before, so I cannot do anything. Don't let your family people get to you. Okay, so just write something and make sure that what you are writing, if you read it, it is making a lot of sense to you, and we move on. Okay, let's come to question number 6.
Question 6. Accounting policies are very fundamental to financial reporting in both the public sector and the private sector. You are a member of an expert group established by the controller and accountants to advise on accounting policies of covered entities, adopting accrual basis of accounting. The group has tasked you to identify the key areas that accounting policies of the covered entities should cover. Required. Explain accounting policies and discuss 4 areas that the accrual accounting policy should cover in the covered entities.
Okay, so the first one is we should explain accounting policy. What is accounting policy? Not Accounting policies. Accounting policy, not policies.
Yeah, the specific rules and principles and bases that are adopted by an organization in preparing and presenting financial reporting. And they are institutional specific.
Okay, that is fine. That is fine. Okay. Maybe they want to maybe someone might want to write that again. So if you can take it again.
Principle basis.
Yeah, they are the rules, principle basis adopted by an organization in the presentation and preparation of financial statements.
Okay. Okay. So the principles would be how do we recognize revenue? Our consumption of capital, our measurement of assets, our measurement of inventory, all those issues, how things are being done, how those things are being put in the financial statements, are what we call the policy. They are the accounting policy. Okay, so how do we measure assets? All assets should be measured at cost. Okay, when we purchase land, how do we go about it? Land should not be what? Land should not be, consumption of fixed capital should not be charged on land. Whenever we purchase equipment, the equipment should have a useful life of 10 years. That is part of a way, or that is a principle as to how these items should be recognized in our books. So accounting policy are those principles. Accounting policy is the principle, the methods that are adopted by an entity in the preparation and presentation of their financial statement or their general purpose financial reports. If you want to develop accounting policy, what are the key areas? Or they're just talking about, they're just asking you that, what are the areas that you can develop an accounting policy for? That's what they are going to be talking about. Okay. And if you have prepared financial or final account for public sector before, you don't have to have problem with the areas. What are the key areas? I hope we have looked at this the time that we were doing accounting concepts. What are the key areas that we spoke about?
I think revenue and expenditure.
Okay, so we look at the recognition of revenue and expenditure. So you have to now see when should we recognize revenue, when should we recognize the expenditure. So we have the valuation of inventory, okay, basis of accounting. And the basis of accounting is also accounting policy. So we recognize transaction when cash is being received or when cash equivalent is being received or paid. So the basis of accounting is also accounting policy. Valuation of inventory, recognition of revenue, that is also accounting, okay, policy. The measurement basis for assets. How do we measure assets is also a policy. So you talk about the measurement basis for assets, the pattern of capital consumption. How do we consume our capital assets? Okay, so the consumption of fixed capital, that is also going to be accounting policy. Whenever we buy a building, the building should be consumed over 50 years. That is a policy. So anytime that we have a building, that is going to be 50 years. How do we value our inventory? Inventory should be valued at lower of cost or replacement lower of cost or replacement value or replacement cost, depending on the purpose of that particular inventory. So any inventory that will not be sold, inventory that can only be used. Example, the stationery will always be valued at the lower of cost or its replacement cost. The inventory that can be disposed, inventory that can be disposed, okay, will always be valued at the lower of the cost or the next valuable value, because we can actually and get an amount from it. So valuation of our inventory valuation, cost measurement for assets, recognition of revenue, basis of accounting, the pattern of what? The fixed capital consumption. You can talk about those ones as the areas of what? The accounting policy. You can develop accounting policy to cover those important areas. Okay, that is about that. Okay, let's take the question 7. Then we see.
Please,
Yes, Ina.
yeah, before we proceed, I realized that in the public sector, you always use the consumption of fixed capital.
Yeah.
In any case, if anybody uses depreciation, is it the same? Is it going to be marked wrong?
Yes, I'm sure, because we are now using the gift means classification, and in the gift means classification, it is consumption of.
It's a consumption of fixed capital.
Yes, please.
So we should be mindful of the terminologies we use.
Yes, please. Yes, please. Okay.
Okay.
Yeah, senior AGM. Yeah, your hand is up.
Yes, sir.
Yes, senior.
Sir, please, in relation to the accounting policy, assuming it's about an asset, a vehicle,
Okay.
are being asked, are you supposed to know the initial recognition, subsequent recognition, then the depreciation policy, there may be derecognition criteria you will use?
Okay, if you are asked about the policy that will be on the asset, isn't it?
Yes, please.
Okay, so you know
Of
that,
the policy.
yeah, you know that the asset is going to be, as soon as you purchase the assets, you are going to be recognizing the asset, isn't it? Subsequently, you also have options to carry this particular asset. Okay, subsequently, you also have an option to carry this particular asset. Okay, and the pattern of it has to do with everything about the asset. The initial recognition of the asset, the cost measurements. Are we using fair value, or we are using what? Market value, or we are using historical cost? After the asset is now in books, in our books, how do we charge the what? The consumption. So we have a policy as to what the consumption of the fixed capital, and what would be the subsequent measurement, either cost model or revaluation model. Okay, so it has to be with the initial recognition of the asset, which is a cost measurement, the pattern of the consumption of the asset. Then we also look at the subsequent measurement of the asset, which will be either the cost model or the revaluation model. So all of these things have to be in place before you even, whenever you purchase the asset, you know that, okay, the cost asset that we are going to be purchasing, it should be initially be recognized at cost plus any direct attributable cost of bringing that particular asset to the state that it will be available for use. Okay, the one that you know in IAS 16 also applies to IPSA 17. The standards are all the same, but just that they have a change of name. So what is the initial recognition? What will be the subsequent measurements? So you have to talk about how you are going to be having this in place before you even purchase the asset, or if you purchase the asset, you have to now determine this, and this will now be there for all assets that will be coming in that particular form. So your initial will be coming in, the subsequent as to consumption, and also the subsequent measurement, revaluation, or cost model. You have to determine all these things for the assets. So you have to talk about all these ones. It's not okay.
Okay, thanks.
All right.
For 5 minutes question or 5 math question or 10 math question, you'll be saying all these things.
You don't have to talk plenty. So small. Just have to make sure that this, even in
you capture the salient points.
Yeah, even within 3 statements, or maybe 5 lines, you can put all these things together. Okay. You don't have to explain. You don't have to explain to the examiner what is the meaning of revaluation model in full. No. Okay, they are just saying the accounting policy. So just talk about, okay, revaluation model. Something small about it. That is okay. We are good to go. Question number 7. Let's try that and try some other issues about how some of the questions about the measurement, the qualitative characteristics will be presented to you. Then we look at that and see. Yeah.
Question 7. The conceptual framework for general purpose financial reporting by public sector entities, the conceptual framework, is a document developed and approved by the International Public Sector Accounting Standard Board. The framework provides guidance in dealing with financial reporting issues not dealt with by IPSAPs or RPGs. In these circumstances, preparers and others can refer to and consider the applicability of the definitions, recognition criteria, measurement principles, and other concepts identified in the conceptual framework. Required. A. Explain the two main mandates or objectives of IPSAPs established by IFAC. B. Distinguish between general purpose financial reporting and special purpose financial reporting. C. Explain two constraints on information included in general purpose financial reports. D. Discuss four measurement bases of assets identified under the conceptual framework for general purpose financial reporting by the public sector entities.
Thank you. Okay, I hope I've said about I've mentioned the mandate and the objective of the board. The time I was doing the time I was talking about the conceptual framework.
Yes.
Okay, so what were the things that I said?
That issue standards.
Okay, please, even if you have forgotten, any board, any accounting board, the main purpose is to develop and issue what? Standards. Okay, so they should issue accounting standard for public sector entities. That is the first one. So you cannot just issue the standards. No. If you issue the standard, you have to ensure that people are accepting and people are also applying what? These particular standards. Okay, so there are two. The first one is that the main objective or the main mandate is that they have to what? They have to issue quality accounting standards or public sector accounting standards for public sector entities. After doing this, they have to make sure that these particular standards are being accepted and are being applied by what? By the public sector entities or the preparers of the what? The financial statements for public sector entities. So the first one is to issue quality accounting standards for public sector entities. And also the second one is to ensure the acceptance or promote acceptance and also the convergence of what? Of the standards. They have to make sure that the standard is being accepted by those who are applying the accrual basis of accounting. And this thing is going to be applied, maybe they have to make sure that this thing is being unified. The standard is being unified. So every entity, every public sector entity in the world that is adopting accrual basis have to prepare this, have to adopt the IPSAS or have to accept the IPSAS and use it in the preparation so that there can be an easy comparison among what public sector entities, or they can easily have access to donor funds or whatever they are going to be doing. So the main objective is that they have to issue accounting or quality accounting standards for public sector entities, and they also have to promote or ensure acceptance of these standards. That is their main objective. The other one is to publish articles or studies that promote the application of the standards. So if we have the articles from individuals, like there's last time you can see that I posted a note on accounting for cryptocurrencies. Okay, this is something that is not covered by the standard. Okay, so this is an issue. So they can take this one and now publish it on their website. That is going to help people in what? In applying the reporting standards. Okay, so this is an important article that is going to help people to apply the standard. That is going to open people's mind to the application of the standard. So they can accept this and publish it so that those who are using the standards will look at it and it will also broaden their knowledge about the understanding of the standards. Okay. Distinguish between general purpose financial reports and special purpose financial reports. I hope I have said this one also, isn't it?
Yeah.
All right. So let's take them again. General purpose financial reports and the special purpose financial reports.
I think generally is for those who don't have that authority to request for the preparation of a specific financial statement tailored to meet their needs.
Okay, okay, okay. And the special?
Special is for those who have that authority, like Parliament can request a controller and accountant general to prepare a specific statement for them to analyze and see.
Okay, okay. So that is basically the general purpose is the one that we have, and the specific one or the special one is for those who have the
People of class.
Okay. Yes, people of class. So those who have the right to request for such preparation. Okay, it is not going to be in the domain for the public to have access to. No, it is going to be restricted to a particular number of people. Okay, and that is what we call the special. It's for a special purpose. It is prepared to meet a special purpose or a special requirements. And this will not be given to no. If you look at if you go to the website of some of the district assemblies, you can see their financial statement there. That is given to everybody. But there are certain information over there that will not be put up there. Example, like maybe their asset management. They cannot put information like asset management there. But the parliament can request them to give them information on how they are managing the asset. This information will not be published on the website because it is not for the public. It is for the parliament, which is a specific body or institution that is requesting for that particular information. So that is basically the difference between general purpose and the special purpose financial reports. Let's come to the C. Explain two constraints on information included in general purpose financial reports. Okay. What are the constraints? What are the problems that we are going to be having on information included in the general purpose financial reports? All information over there should be having certain characteristics. And what are the things that will make information included over there will not be having those characteristics? That is the constraint that they are talking about. We are saying that information should be relevant, should be faithfully presented, it should be timely, it should be comparable, it should be verifiable, it should also be understandable. But the question is, can we have all these things looking at the time? No. So those things that will be preventing a particular information to have all these things or to have specific characteristics, those are the things that we are talking about, a constraint. The issue of verifiability. If we want to verify this, if you want an audited report, is it all the public sector entities that can afford the auditing, the service of an auditor? Or if we want to make all information available within a year, we need a lot of people to be doing this. And looking for a lot of people, it means that we are going to be spending money again. So sometimes you look at the cost of you getting this information ready, the cost of you making this information to have these characteristics, and the benefit that this information will be bringing to you. So sometimes we look at the cost-benefit analysis. Look at the volume of our transaction. Before we can make this particular information available within a year, we need a lot of hands. This a lot of hands means that we have to employ people and pay them. At the end of the day, what is the investment that this particular information, if we put the information there, what is the investment that we are getting? How is our sales increasing? How is our revenue increasing? We are not seeing an increase. We are not seeing anything. So it means that the cost of us getting this information ready or this information available is higher than the benefit that we are getting. So what we do is that we can present the information anyhow, or we can decide not to engage auditor. We can decide to just omit some of the information and put some of them there. And that is going to be violating some of the characteristics. So sometimes the first constraint is a cost-benefit analysis. The cost that you have to incur to make the information available or to make sure that the information is having the characteristics of relevance, faithful representation, verifiability, and those things, the cost that you are going to be incurring, and the benefit that these statements are going to be given to you. If you look at the two, you see that no, The benefit that this is bringing is lower than the cost. Therefore, people will choose not to adhere to all. Yes, we can put up information there without without a stamp of an auditor. Okay, we know that even without that one, we will still have our owners with us. Our customers will still be with us. It is not going to be bringing additional person. Okay, so we can ignore that part of the verifiability and just publish the statements. So the constraint they are talking about, those issues that will make a particular information included in a financial statement or make a financial statement or general purpose financial report not to have the required characteristics. That is a constraint.
Please, sir.
The cost benefit.
Please, sir.
Yes, yeah.
But when we base it on that, looking at the people who are going to benefit from the general purpose, the entire country, compared to Parliament, which is just a single body. When we are doing cost benefit analysis, when masses are benefiting, is it not better than when just specific people are benefiting?
The benefit of the masses, what is it bringing to the country as a whole?
Yeah, it get them informed and they will be well about their responsibilities. Because when I know how my tax is being put to, I'll be happy paying more tax.
We are going to give you information on direct tax. Okay, but we are not going to be giving you information on all the items. It doesn't mean that not all the items will be disclosed. Some of them we need to do extra work, and the cost of us doing that particular work is going to be higher than the benefit that we are going to be getting. So we can ignore that particular. It doesn't mean that the statement itself is not going to be having any item that is going to be correct. Those that we cannot spend much to get them to be the way they are, we will put them there. But those that we need to do a lot of work on them to get them there, we cannot do that because the benefit is lower than the cost. Okay.
All right.
So
For academic purpose.
It's not that they are not going to be, not all the information will be there. We are not concerned about whatever, if you know how your taxes are being used. Even if you don't know, there's nothing that you're going to be doing. You will just shout and calm down. We are talking about maximizing the resource, we are minimizing the resources of the country. We cannot go because we want the citizens to know how we are spending their money. We need to come and hire somebody from Ukraine. The person will be the person we are going to be booking the flight for the person. The person will come to Ghana here. We are going to pay the person just for the citizens to know how their taxes are being used. And at the end of the day, not all of them will be paying their taxes. No. We are the same people that will be saying that as Nonado was taking other private jets to go and represent Ghana. What are you people saying?
But at least that's better. Taking Ukraine people to come and do that thing is better than wasting it in the air.
It is well. Let's move on. All right. Another one also has to do with issue of the time. Okay. So we also have the issue of the time. Okay. Sometimes the information will be needed, like the information will be needed within a short period of time. And someone might end up, because of the pressure, the person might end up giving an accurate giving inaccurate data or information that particular person. So the time also, the duration for the information. Okay, you just call me right now that within the next 30 minutes, you need the information on this. How are you expecting me to give you accurate information? I will just try my best, and my best will not be enough. So I will be giving you inaccurate information. So another factor is also the time. Another one also has to do with the materiality. Okay, another one has to do with the materiality. So we'll be saying that, okay, someone will be purchasing nails. Okay, one organization might be expensing that particular nails, that okay, the amount involved is not that huge. One of them will be will be capitalizing the nails and be consuming it. If you want to compare these particular entities, their performance is going to be very difficult, and the issue of comparability will not be achieved because one of them is considering nails to be immaterial and none of them is considering nails to be material. So how do we compare their assets? How do we compare their surplus? Their performance will be, so the issue of comparability will be very difficult to achieve there if we are using the issue of materiality. Okay, the issue of materiality. Someone can also, sometimes they also add, we want to achieve the balance between all the characteristics. So we end up ignoring some of them. Okay, we want to achieve the balance between them. So we want to say, okay, if we are talking about issue of relevance, then timely should be there. So issue of relevance does not necessarily mean what the person should be able to compare. Issue of relevance should also not be as a result of the person be able to understand. So since the person can get the information on time, then it means that information might be relevant to the person. So we try to achieve the balance between them and ignore some of the characteristics. Okay, so sometimes you can also see balance between the characteristics. We want to achieve balance between them. So if we want to achieve relevance, then it means that the information should be on time. Certain characteristics might not be attributing to relevance, so we have to ignore them. That can also be a constraint on the information in the financial statement. Discuss 4 measurement bases of assets. What are the measurement bases? Then we pick some questions, then we call it a day for today. Measurement basis for assets. How do we measure assets?
Historical cost.
We use the historical cost. What again?
Current
value.
Current value or
Market
market value. Okay, replacement cost.
Net selling.
Okay, net valuable value, and also use value in use. I hope you can be able to say something about them. Historical cost is where the asset is being recognized at the amount that it was originally purchased. Current value, you are talking about the current market value of the assets in the market. Okay, or the fair value. How much is the asset? Or between two independent people, what is the value that they are agreeing on currently? That is the fair value. We can also have the value in use. What is the present value of the benefit that we are going to be deriving from using the assets? So if you want to continue using the asset, what is the amount that you are going to, what is the benefit that you are going to be getting? What is the today's value of that? That is what we call the value in use. Net realizable value. Assuming you want to dispose the assets right now, what is the net amount that you are going to be getting from this? This will always be the fair value less cost to sell. If you want to sell the asset for 15,000 and you are going to be transporting the asset to the person and you incur a cost of 2,000, the person will only give you the 15,000 and you are going to be settling the transportation cost yourself. At the end of the day, you are getting only 13,000. That's what we call a net realizable value. What you have to know is that the accounting policy or the basis of accounting that you are using determines what the measurement basis that you are going to be using for the items. You always have to be able to link the measurement basis to the basis of accounting. If you are using cash basis, how do we measure assets? If you are using cash basis, how are we going to be measuring the value of the asset?
Historical cost.
Use the historical cost. Okay, the amount that you purchase for the purchase price is the price of the asset, because we are just measuring the asset at the amount paid for the asset. So historical cost will be the what? Will be the measure, or the purchase price, or you can name it purchase price. But if you are using accrual basis, you can decide to use any of these measures. So you can use the historical cost if you want to carry the asset at cost model. You can use the value in use if the asset is not an asset that you are paying for. If asset that is being given to you are in a form of donation, if you don't have the fair value and those values available, you can look at what the benefit that the asset will be given to you, and you can use that as a measure. So if you're using cash basis, the only measure of asset is the historical or the purchase price. But if you're using accrual basis, you can use any of them. You can use any of them. If you count liabilities also, the measurement basis for the liabilities is determinant on the basis of accounting that you are using. If you're using cash basis, there's no liability. So you are not going to be using anything. But if you are using accrual basis, You can decide to measure the liability as the historical cost, the amount that you have incurred, the amount that you are owing the person, or you can use the assumption price. You can use the cost of release. You can use the fair value. So the measurement basis, you should be able to link the measurement basis to the basis of accounting. They can ask you a question on that, and you have to be able to link that if there is a need for that. Okay, let's count to question number. Okay, let's take the question number 9 so that, yeah, sit down. Your hand is up.
Sir, please,
Yeah.
with the measurement basis, how do you relate it to the financing capacity, operational capacity, the objective of measurement, and with the the qualitative characteristics?
Okay. 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 We want to determine financial capacity of the entity. Okay, the financial capacity has to do with the money that you want. So if you want to measure assets, what basis do you think? What basis do you think will be appropriate if you want to determine financial capacity for assets? What basis do you think? Yeah, Senior, I'm still with you. Senior AGM, I'm with you. If you want to determine financial capacity,
historical cost.
financial capacity. Do you think the historical cost will be appropriate?
The net realizable value.
Okay. Okay. That is also the net realizable value. That is if we have the intentions of disposing the asset.
To sell it.
Okay.
Yes, the value in use if you want to use it.
Okay. Okay. So if you want to determine the financial capacity of the entity, I think the best one, okay, you can use any of them depending on what you want to achieve. But we want to know whether the entity has the capacity to be able to provide this. Okay. You can use current market value, or you can also use value in use. The financial capacity has to do with, do we have the resources, the asset right now? What is the value of the asset? So you can use current value. Okay, so if you want to determine the financial capacity, do we have the resources? So you can also use historical cost depending on what you want to measure. So what is the most appropriate measurement basis if you want to determine the financial capacity of the entity? You can look at the current market value or the replacement cost of the assets. If we want to replace this particular asset, or if we want to scrap this particular asset right now, do we have the resources to be able to replace it? So you can also use the replacement cost as the measurement basis if you want to determine the financial capacity of the entity in terms of assets. Okay, if you come to liability, if you want to determine the financial capacity, liability is the amount that we are going to be paying. Okay, if we want to settle the liability, we can use the historical cost of the liability because that is the amount that we are owing the person. So if we want to settle the person right now, what is the amount that we are going to be using? Or if we want to release, or if you want to exit the liability right now, what is the amount that we are going to be using? You just use the most appropriate method depending on what you want to achieve. If you are looking at the financial capacity or the operational capacity of the entity, the operational capacity has to do with having the capacity to put to the going concern. So you can use the historical cost for that, for the assets. This is the amount that we have for assets. Yes, please.
Liabilities that has a fixed interest element, that like interest cost.
Okay.
That will increase their value over the period. Can we use historical cost?
We are going to be paying the interest unless you are not paying
the
interest. If you are paying the interest, you are going to be paying the principal at the end of the year. So you can still use the historical cost. But if you are not paying the interest, then you have to use the current value. What is the value of the interest plus that particular principal? Okay. So
Okay.
the operational capacity and then the financial capacity, you just have to determine the most appropriate depending on the direction that the entity want to go. Operational capacity, do you have the capacity? We can use the historical cost. That is the amount that we have purchased the asset, or someone can use the current market value. What is the number of units that the entity can produce now? The current, based on this particular asset, what is the what? What is the number of units that the asset can produce? So we just look at the current capacity of the entity. We can also use the current value. We can also use the current value depending on what they are or you want to achieve in your measurements. Okay, the direction that you want to go. So any of the measurement basis can be used depending on what you can use, but you just have to choose the most appropriate one. Which of these measures represent the what? The best alternative for the entity. That is what you have to pick as the measurement basis. And you also ask about how do we relate that to qualitative characteristics?
Yes, sir.
Okay. Like I really don't get that. If you can give me enough information on that, how we should relate the measurement basis to the qualitative characteristics. Like if you come to the issue of
yes, like assuming you are using the historical cost, the verifiability is achieved and other things.
Okay. So if you come to the faithful representation, if you want to talk about assets for you to achieve the faithful representation, the best option that we can use might be the current value of the assets. Okay. If you're using the historical cost, it can happen that in the market, the value of the asset is not that one. So you are lying to us based on this particular assets. So you can use the current value or you can use the net valuable value. Okay, you can use the current value of the asset. That is representing the current or the most recent information about that particular asset. So we can use the current values or maybe the net valuable value if the current values or the fair value are not available. So you can use the fair value for the asset measurement, and that is going to be giving us the issue or the faithful presentation. We are giving accurate information about the assets. So what is the value of the asset in the books now? We can use the fair value. But if you are giving us historical cost, and the historical cost, the current value is 10,000, the actual value of the asset is 8,000, this is going to be affecting our decision because we might be misled with the information given to us. So fair value will be okay for the faithful representation. Okay, for relevance, we want to make decision which will be predictive, which will also be confirmatory. So you can give us the historical values together with the fair value or the current market value. So we can look at the historical, we are going to be confirming things that happened in the past. So we can be able to make reference to the purchase price, and we can also make reference to the current price and also what the price that will be in the future. So historical cost, the current market value might also be achieved for that particular one. Okay, for understandability, we can use the historical cost because we are going to be looking at the consumption pattern. So historical cost will be able to understand why this particular value is actually here. We can go to the footnotes and now look at the consumption. Okay, so I don't think if I've been able to at least
you've done justice to it. Okay. Thank you very much.
All right, Sina. Okay. So question number 9, let's take the last question. And
Question 9. The following revelations were made about the financial reporting process of a covered entity. A. The users of the financial statement of the entity is less interested in the financial information because it does not provide information that enables the users to either confirm their expectations or make predictions. B. Equipment purchased during the year was recognized as expense in the statement of financial performance, even though the entity applies the accrual principles. C. The revenue transaction of a significant value was completely omitted from the financial statement of the entity unintentionally. D. The financial statement showed the budget amount alongside the actual amounts of the year in the statement of financial performance. E. The accountant confirmed that some records relating to expenses were done based on WhatsApp messages, online text app for the principal spending officer. Required. Explain how each of the transactions A to E would affect the specific qualitative characteristic of the financial statements of the entity.
Okay, please, this is one of the ways of setting questions on the qualitative characteristics. Another way is that they can give you a statement, then they'll add some footnote to it, or they will just give you a statement without adding note to the account. Okay, or they can give you a statement, they will include the budget information. So you should be able to look at the statement and say, okay, this statement is going to be relevant or it's not going to be relevant. Why do you think so? You have to say it. This statement is going to be ensuring principle of comparability. Why? Budget information has been included. This question is going to be achieving the purpose of verifiability. Why? Note has been added to the account. So they can give you a full statement on its own and they'll ask you to identify, or they can give you some practical situations like this, and they'll ask you to be able to identify for each of the transactions the qualitative characteristics that will be affected in any of these cases. So let's take this one. The first one is that the users of the financial statement of the entity is less interested in the financial information because it does not provide information that enables the users to either confirm their expectations or make predictions. Which of the characteristics?
Relevance.
Okay, so this will be issue of relevance. We say that the issue of relevance, the information should
Confirmatory, predictive value.
Should be confirmatory, or they should be having a predictive value, or information should be serving the purpose that it has been intended for. Serving the purpose, we can be able to make decisions as to what is going to happen in the future. We can also be able to confirm certain things that has already happened. So since this is not here, they can even omit this side. Okay, they can even omit this side and they will not say anything. Okay, so the users of the financial statement of the entity is less interested in the financial information. Okay, they can put something there. Okay, and this might be having maybe at least, you can have a question that will having at least more than a characteristics. Okay, so they can just say this one. What are those things that is going to be making users not to be interested in a particular financial statements? One of them is that it might not be relevant. Okay, one of them is that it might not be understandable. The information included over there is not understandable for the people. The people cannot actually understand it. Okay, it might not necessarily mean that it is free from error, but just that it might be in all aspects, it might be relevant, but just that we don't need it. So it's not relevant to us, or we don't understand what they are talking about. It's not verifiable. It can be verifiable, but we don't need it. It's not relevant to us. So we can talk about issue of relevance and issue of understandability over here. Information can be verifiable, it can be comparable, but since it is not relevant to us, we are not going to be interested in it. Or since we don't understand it, we are not going to be interested in it. So they can just cut over here, but for you to be able to identify a specific one, they decided to add because they are not able to do that. Okay, that is the issue of relevance. So after identifying that, you just explain what the relevance is and why you are saying that this is not what this is going to be affecting the issue of relevance. So you just state that. First explain what the relevance means, and then state why you are saying that this particular item or transaction or this occurrence is going to be affecting the principle of relevance. The second one is equipment purchased during the year was recognized as an expense in the statement of financial performance, even though the entity applies the accrual principle.
Faithful
Faithful
representation.
representation.
Okay, why are we saying that it's a faithful representation?
Material error.
Yeah.
Okay, so
They
someone
were
can.
supposed to capitalize it.
Okay. Okay. They are supposed to capitalize it, but it
They
has been
expense
expensed. Okay. Any transaction that is going to be classified wrongly will be seen as what? Your financial statements is not faithfully presented because this asset should be classified as what? It should be shown as what? Capital asset. It's not an expense. So the information that you are giving to us is not accurate. You are giving us a false information. As soon as you are giving a false information, it means that that particular information is not faithfully represented. The asset should be presented as what? The equipment should be presented as a capital asset, non-current asset, not an expense. So it means that you are not giving us what? A correct information, and the financial statement is shrunk because of the wrong classification of the item. So the statement is not faithfully represented. C, a revenue transaction of a significant value was completely omitted from the financial statement of the entity unintentionally.
faithful representation.
Okay, so this particular statement that you are giving to us is not giving us a true view of what, or the true value of the revenue. That means that some of the items are not there. As soon as you are holding on to some items, or as soon as some of the items are wrongly classified, it means that you are not giving us a complete information. Since you are giving us incomplete information, it means that there is a problem with that. The financial statement that you are giving to us, it is not reflecting the actual what results. So it is not faithful. It is not what faithful. So this is an error, and this is going to be making the financial statement what incomplete. So that is a faithful representation. The financial statement show the budget amount alongside the actual amount of the year in the statement of financial performance. This will be what?
Comparability.
Comparability.
Okay. And the last one is what?
Verification.
Verification.
So we cannot be able
Verifiability. Verifiability.
there is no supporting documents to verify whether this transaction has been done or not. So this will be the issue of what? Of verifiability. So this is one of the ways that they can give you a question on the qualitative characteristics. All right. And please, I'm saying that the cash basis, they don't have much areas over there. So it's always about maybe the challenges of adopting, or the benefits of adopting the IFSAS or the accrual basis, or they can give you items and ask you to differentiate between the cash and accrual basis using those items. So they will give you revenue, they can give you expenditure, they can give you assets, they can give you liabilities. We are only talking about how the transaction are being recognized under each of two bases that will be giving you the differences. Or they can give you question on the public sector accounting techniques, which is the fund accounting commitment and also the vote or the appropriation accounting. You need to read on them. Question 1 is for 20 marks. Whether you go to heaven and come back, it will always be conceptual framework or conceptual framework and then the accounting policies and concepts. Please, we are through with this one. I will add the remaining questions that I will share with you during the day. I want to add the final account questions and also the other questions. So tomorrow we'll be looking at the question number 4. That will be the public requirements and also the public-private partnership. That will also be question number 4. 10 marks each. All right. Please, any question? All right. So if there are no questions, I will see you guys tomorrow, and we will see what will happen. Thank you all for coming. I'll see you guys. All right.
Okay.